Welcome back to TradeDelicious Live. It's morning briefing. It's 8:30 a.m. Let's get into a little bit of morning briefing. This is a show where both John and I, we're going to debate different positions. We're going to talk about some of the fundamentals, and we're going to get you up to scratch with everything that you need to know. Good morning, good morning, good morning. Welcome to TradeDelicious Live. My name is Jordan. This is John, and you're watching Morning Briefing. It's just gone 8:30 a.m. British Standard Time, 3:30 a.m. Eastern Time, and 3:30 p.m. AWST out here in Perth. Honorable mention. John, good morning to you, and welcome to Morning Briefing. We missed yesterday, so we've got a lot to catch up on. We've got a lot to chat about. How are you feeling?
Yeah, I'm doing really good, mate. Doing really good. Like I was playing too early. Nice and warm in the UK today. So got sweaty palms right now, actually.
It's the nerves about being on TradeDelicious. That's all it is. It's just how big of an occasion this is for everyone at home. But yeah, no, you do have good weather, and I've had it confirmed by Mr. Paul Brown coming in. Hot, sunny Essex with clear blue skies as far as the eye can see.
Love it. Love it. I mean, let's face it, we've got to take it when we got it. You know, I'm not going to complain. I've said my one complaint about sweaty hands, but that's about it. I ain't going to complain about nothing else because we get it very rarely, and I will take it.
I don't think it's possible to complain. 27 degrees is, I think that is the perfect weather. The perfect weather. But good morning to everyone in chat. I hope you missed us. I hope you missed us yesterday. If you did, let us know. A little bit to go through. Obviously, the last time we left, last Friday it was, we established 1 + 1 = 0 hedge fund. Very, very, very profitable hedge fund that we found out. 100% win rate when it's gone through. Boss is very happy. But that was a really enjoyable Friday. If you guys missed it, both John and I took over the live London trading floor, and we tried a new tactic, a new teamwork exercise in exiting a couple of positions, and it was good fun. What do you reckon, John?
Yeah, I really enjoyed it. You know what? I've actually been telling everybody about it all weekend. Like, I saw my dad over the weekend. I was like, me and Jordan were doing this thing, and it was really exciting. Like, you know, and yeah, I've been telling everybody about it, even people who don't really know what to do. I've just been like, yeah, well, I was doing this, and they were like, "What are you on about?" I was like, "It's the greatest hedge fund you will ever see."
Going to be up in the stars. We're going to have
Yeah,
a nice billboard in New York Times Square.
yeah,
It's going to be incredible. But no, it was good fun. So I hope you guys did enjoy that on Friday. A little bit quiet over a stream, but I think it's because we were concentrating and we were heavily engaged in what we were doing. It
yeah.
sparked a few ideas for future content, but what brings us back to Monday morning. Wrong. Tuesday morning. It brings us back to Tuesday morning. You've had the day off. What have you been having a look at? What have you been seeing across yesterday and into early this week?
Oh yeah, well, it's a bit quiet actually. Quick, bit quiet on the markets this week. In terms of just general data, we're obviously looking probably more towards headline stuff. We've got the European elections coming up this weekend. I think the French elections on the 30th of June, which is Sunday. So that could be a bit more volatility towards the end of the week, maybe going into the start of next week. Obviously, depending on the result of that, we could see some big swings, especially if we see the sort of rise of the far right political parties. That could be some risk for the euro, I think, going into this week. Whether the markets will try and price that in this week, we'll have to wait and see on that. I haven't really seen much so far. I am short in the euro at the moment.
Hmm.
So I'm looking for active positions to try and get short on the euro, but that's because of the fundamental play plus other analysis that suggests that maybe the euro is still a little bit weaker across the board. So looking to try and take advantage of that. We're seeing a little bit of a pullback in the US dollar, which kind of stemmed from last week, and he's kind of following into sort of this week as well. Whether that will rebound as well, we haven't really got too much in the way of dollar data apart from Friday, which is going to be a biggie, which is that core PCE price index. That is going to be a big market mover. I think if that comes in line with expectations like CPI or well misses to the downside like CPI and PPI, then chance of a cut might actually go up a little bit more for the Fed. I know we've been saying that they're likely not going to cut for a while, maybe even after the election. I still feel like the labour market is going to be the key driver, but that would be in line with their expectations. So, why shouldn't they cut is probably what everyone's going to be asking for if they are seeing things like other countries essentially are cutting rates right now.
Yeah,
With kind of less information, I guess.
yeah, I guess that, and there's something really important that you've mentioned there for you guys. If you don't have a look at fundamentals or economics in your trading, why is PCE so important? And this is because this is what the Fed have openly come out and said. Hey, we use this to track inflation. They don't really use that CPI data in the same way that most other economies do and central banks do. They use CPI to gauge where inflation's at and then base their interest rates off that. They use PCE, which is the derivative of, or not a derivative, a kind of inflation, right? It
Mm.
measures the price of goods and services that are actually consumed by consumers. Okay, excluding food and energy, I think it is that it excludes.
Yeah, X autos and stuff.
Yeah, yeah. So it's what the actual individuals on the ground are spending their money on and what's actually being consumed. Whereas as core CPI, while it does also exclude the what is it, food and energy as well,
Yeah.
it doesn't. It also includes what businesses consume and all of those what governments consume. Whereas PCE is looking at the consumer itself. So it's a bit more of a niche reading on that inflation. And that's why the Fed care about it a little bit more. It's a little bit more prominent with what's felt on the ground. And that's why that's going to be so big leading up on on Friday. A lot of people aren't aware of that because most economies use CPI. They assume CPI is what the Fed used to gauge inflation. They've openly come out and said PCE is arguably the biggest
Yeah.
driver of their interest rate decisions.
Yeah, it's their primary use for gauging inflation.
Yeah,
So that's the one that we should really be. Obviously, we get the CPI data before this data, so that's why it's looked at more closely because it's kind of like your almost like your initial sort
your
of
leading indicator.
indication. Yeah,
Yeah,
kind of like of what's going to happen. So that's why CPI is used or more popular, I'd say, if you are looking at sort of data points and whatnot. But you really want to be looking at core PCE, because if that does come in line with expectations, then that's what the Fed are going to be leaning more towards. Like I said, though, I still feel like the labour market is something we need to keep our eyes on. We need to see an increase in that unemployment rate for me for Fed to really start to get worried and wanting to cut rates. But it just, I don't know how the sort of market will start to price that if it does start to fall in line. I haven't looked at the Fed Watch tool in a minute, to be honest. Usually I have a look at it every week, but I haven't actually looked at it this week. Been a little bit busy, so I haven't really had a look at where the market participants are pricing in those cuts. I imagine it still would be sort of around November time. But I would,
let me
yeah,
pull it up.
I'd just be interested to see if anything changes in that kind of respect.
Yeah. So PCE is obviously a big one to look in for the US dollar. We're seeing a bit of a unrelated to currencies, arguably. Nvidia having a bit of a drop off.
Mm.
Having a decent drop off. Jim Cramer called the top in classic
Yeah.
Jim Cramer fashion. He absolutely nailed that top. I seen a tweet about it as well, and he
Yeah.
really did nail that top. That was the day that it peaked. But we've been chatting about this. Haven't got any short positions. Haven't got any risks towards the downside on my end. Definitely want a little bit of kind of downside pressure there. We've kind of gone through when it's getting that much press, it's usually done. It's getting much more press than it deserves to be. The price to earnings ratio is mental, and the amount of insider selling is astronomical.
Yeah.
The amount of people selling shares that work within that company, and they've got actually a bit of a problem. There's a few rumors coming out that a lot of their technical leads, a lot of their bonus structure in a public company is shares. And a cheaper way for businesses to actually allocate these shares to staff is through options contracts. And they do
Mm.
those options contracts through their bonus structure, and that's how they're paid. Some of these big technical
Yeah.
leads. There's rumors some of the technical leads options contracts are worth over 20 to 30 million US dollars now because of this run. And a lot of them are handing
All
in their
cashing out.
notice and retiring. Yeah. So they're retiring, going, hey, I've done my bit, I've made my 30
Yeah.
million. And the problem is they're the key leaders driving Nvidia to its new success. How do you incentivize someone who's getting paid $40 million on top of their $400,000 salary?
You can't.
How do you
Can't.
incentivize that? That's a big problem to have. So yeah, there's a few rocky waters or rough shores, should I say, coming up for Nvidia, I think, in the near future.
Yeah, that's really interesting because, like you said, if someone paid you 40 million, you ain't hanging around, are you? You are not hanging around.
Yeah,
You're
loyalty. I
off.
mean, that's the thing, right? You're going to hold on to loyalty, but loyalty is a rare asset. But it's also one of those assets where they need to be felt like they're doing the right thing, not just being loyal to the company. So when they're
Yeah.
being a technical lead as well, essentially going to be putting out fires, which can be an incredibly frustrating job because
Yeah.
you're the bottom line of the bad news. The bad news comes, it's your job to fix it, and you've got to get it fixed in time. These roles need to be heavily incentivized. You need to be incentivized to perform because it's going to take a hard yard. You're going to have to manage teams, manage people. It's going to be a tough gig. A pay rise of 20% is only going to give them an extra 40, 50, $60,000 a year. They're getting paid 30 million. Why on earth do they care about your 30 grand a year?
Yeah.
So how they incentivize them? Do they do contracts? Do they want options contracts at these share prices? Are they going to sit there and be like, hey, this doesn't seem
Probably
like
not.
a great deal to me. I don't want the shares at this price. So yeah, funny situation they've been put in.
Yeah, I don't know how this has impacted the S&P. I haven't had a little look at the S&P either. We've probably seen a little bit of a decline in the S&P, I guess, because Nvidia was driving 35% of the move behind the recent S&P climb. So yeah, it'd be interesting whether that starts to be the pullback now on some of these stock indices as well. If that's the way you could potentially play it. Obviously, stock indices will be a little bit different because obviously it's more broad amount of companies that you're looking at. But if it is one of the bigger drivers, then it will have a larger impact. I was seeing that GME actually could potentially have another good run. They've got $3 billion worth of cash, haven't they? That they're sitting on at the moment. So I was reading a little story about them. If they need to essentially kind of diverge from what they're doing at the moment to try and turn themselves into a little bit more of a potentially like a bit more of an investment firm now they've got this 3 billion in cash. So there might be a little bit of a little bit of look on GME, but I need to do more research into that. I literally just read one thing, but it just inspired me to have a chat about that then. But yeah, so these stocks at the moment are going to be hot topics. I guess we'll come into some earnings soon as well. So yeah, it's going to be
Yeah.
pretty interesting.
Rapid fire real quick. Trev, I've just seen your message in chat saying he's got a message from Rich. I just want to put it out there. I messaged you back in the Discord that TradeDelicious doesn't do any copy trading, signal services, or anything like that. We have had a couple people impersonating the TradeDelicious team and reaching out to people within the TradeDelicious community. So let me put it out there and squish that straight away. We don't sell anything. We don't offer anything. We don't do anything. We don't give you anything. We don't tell you to do anything. Right? We literally just sit here
We
for
do
entertainment
nothing.
purposes only. We do nothing. We sit on the camera and we chat bare for 20 minutes, right? We don't do anything. So make sure you're well aware of that. Report the person that's told you to do that. You'll notice that there is a difference in their name code. It is someone impersonating to be rich. We won't reach out to you personally and offer you anything like this. So to squish that well and truly before it catches anyone off guard, it's not us. All right, it's not us.
Yeah.
Always do what Trev's done and ask, especially if it's seeming a little bit sus. There's a good chance if it's seeming sus, it's 100% not us. You block him. Yep. Trev, block him, get rid of him, report him, do everything you need to do to get rid of him. I want to touch on the CME Fed Watch tool. 61% chance of a cut in September.
Okay.
Is what we're at. 61%, 32% chance of staying the same, a 6.6% chance of a 100 basis point cut.
Okay.
Big
So
one.
it's starting to potentially, underneath the table, they've got the changes underneath.
Yeah.
What is that saying? What was the previous?
Let me pull up the September chart. The previous, looking back, 61. Yeah, so a month ago it was a 44.9% chance. It's now went out to 61.7, back into 59, and back out to 61.
Yeah, so they're starting to get the feelers for it, I think. Like I said, if that core PCE then comes in line, and then we've got NFP the following week, so it could be a little bit of a turmoil time for the old US dollar if we do see any kind of continuations in this little bit of a move. So that parity on euro might not be looking so sweet at that point.
We're never going to buy each other a beer because we're
No,
never going to
no.
get to parity or
Either
112.
level, are they?
Yeah, we that spread is too. A hedge wouldn't even bring that spread back in.
Yeah.
But look, let's. I've forgot something very very important. Steven said his McDonald's is up 4% since last week. So good on you, Steven. Well
Nice.
done on your McDonald's play. We forgot the quote of the day. We completely
Oh
skimmed
no,
over the
yeah.
quote of the day. So let's just jump back before we jump into the Canadian dollar. Quote of the day is coming from Stephen King, great author, great director. Actually, I think he directed a couple like It. I think it was It and Shaun of the Dead, or no, Shawshank
Not Shaun of
Redemption.
the Dead, but I mean,
Shawshank Redemption, right?
yeah, it might be, yeah. Shaun of the Dead would not be the one. Cornetto, yeah. That's
Yeah. Anyway, the director of Shawshank Redemption, I think he directed it or he wrote it. He wrote the books. Maybe he wrote it, maybe he didn't direct it. But anyway, Stephen King, quote of the day coming out of Musclay. All around the world, he said, good morning, all around the world. Last week to end the first half of the year. Didn't even realize it is 6 months into the year, middle of winter. We're heading towards summer for you guys. Middle of summer, it's getting hot. John's sitting there like he's been sitting in a fire pit. He's like, oofed. I'm sitting here all rugged up, ready for my Guinness. But let's jump into it. Talent is cheaper than a table salt. Talent is cheaper than table salt. What separates the talented individual from the successful one is a lot of hard work.
hard work beats talent.
All right, give us the
Absolutely.
trading. Flip it to trading.
flip it to trading. You can be talented in the trading industry. I've seen people be very talented at it, and they just seem to pick the right things at the right time, and it just seems to work out for them. But you got to put in the hard work. If you That's the rarity. That's the rarity. You've got to put in the hard work. Get involved with the data. Love the craft. That's what I would say. Get involved with it. Love it. Become obsessed a little bit with it. Um, get in line with the data. Yeah, that's what I would say. That's probably not trading related either, but because that could go across everything. But yeah, I would just say gotta fall in love with the data. That's what I try to do. I tried to go a little bit too in. I was really like, what do I want to achieve in this? How do I do it? How do I get better at the craft? Where are my weaknesses? That's kind of comes into it, I guess. Some your talents, you can be talented at one thing. I might be talented at like picking out the best entries within the market, but my risk management might be absolutely awful. So you got to work hard on your risk management side of things. You might be talented at, I don't know, picking at tops and bottoms within the markets, but you might not be able to hold your trade very long. You got to work hard on those other aspects around your trading. Was
That
that
was
all right?
hard work. That was hard work, wasn't it?
That was hard
That was
work.
hard work to
I
turn
got a
that.
very long way to that point. My brain was just like, where do I go with this?
I like it. All right, let's touch on the Canadian dollar. Big day. CPI coming out today. Obviously at the end of the week we've got the GDP figures as well. What are you looking at for the Canadian dollar this week?
Yeah, so we've got CPI out, expected to come in a little bit lower. Not anything sort of too dramatic there. We did see a little bit of a dovish stance from Governor Macklem yesterday, and the market are pricing in a 71% chance of a cut in July. So we're seeing potentially another 25 basis points cut coming out of the Bank of Canada. I was going to say calendar then, Canada next week, not next week, next month. COT reports still showing heavy buying right now. Obviously, they won't get updated until sometime this week, potentially tomorrow. And COT reports still showing heavy buying on the commercial side of things. So I'll be seeing a little bit of a sort of pre-run here. The unemployment rate in Canada rose, didn't it, to 6.2%. They cut when it was 6.1%. So they're gonna want to see some changes to that as well, I guess. If we do see another little bit of a rise in that sort of unemployment rate, they're gonna fuel that cut even more, and that's going to come out next week in line with NFP data. We usually get the Canada data at the same time, so that could be a driver. CAD's running hot at the moment. CAD is running hot at the moment. We're looking at the dollar CAD chart here. This is only a 4-hour time frame, but we are sort of seeing this market trend lower back towards that 136 handle. So I'm looking for potential CAD plays. My favorite CAD play has actually been against the euro. I've been short Euro CAD, pretty much up here. Originally took some profits down at these lows. I'm out of the trade now, looking for potential re-entries into Euro CAD. You could be looking at weaker currencies as well. The pound could be one place that you could potentially look for some opportunities. Maybe I was going to say the New Zealand dollar, but I'm not comfortable short in the New Zealand dollar just yet. But Euro CAD is dropping aggressively lower. You can see these sort of aggressive bearish moves that are appearing in the markets. We've got this almost like head and shoulders play that's coming out here on this 30-minute time frame, and we're breaking those lows now. So I'm actively looking for opportunities on EuroCAD. Got this little bit of a build up here in terms of consolidation, so might be looking at a bit of a sort of move down and a correction into that level for continuations. We've got all these kind of target lows down here that the market could try and make its way towards. I'm trying to avoid it against the US dollar right now because that market is, although I like trading ranges, it's kind of in the middle of the range at the moment. There's nothing really I want to try and get involved with on the middle of a range. If it was up towards the highs, then yeah, I probably would look for some kind of opportunity there. But EuroCAD to me is a market that's trending lower on this daily time frame. Like the idea of being a seller here, because of the potential volatility around the Europe elections or the French elections. So any kind of significant shocks there could drive euro aggressively lower. Euro CAD could really benefit from that into these kind of 146 levels.
I know because we were chatting about it before, you were already short Euro Swiss.
Yeah.
I've got a personal question for you.
hmm
When looking at shorting a couple of pairs, are you taking that into account when you're wanting to short the Euro CAD?
Yeah,
Obviously,
100%.
already being short Euro, that's just adding more risk to your Euro confluence.
Yeah, yeah, 100%. 100%. If I'm looking at sort of euro as a whole to get short on, and I'm looking at the sort of stronger currencies at the moment, I mean, the Swiss franc, I got in on it more of a technical play rather than a fundamental play. Obviously, we saw the Swiss National Bank cut rates. They're on
Mm.
about sort of intervening either way. They weren't really specific on whatever happened. If they saw a weakening in Swiss, they would intervene. If they saw a strengthening in Swiss, they'd intervene. So they weren't very clear necessarily on what they would do in that regard. This was more of a technical play, but yeah, if I'm looking at sort of currency pairs across the board, I'll be looking to manage risk appropriately across those pairs. Like if I was in sort of, I'm in euro dollar short, euro Swiss short at the moment. So I'm looking at if I want to add risk to euro CAD, then it's going to have to either be at a lower risk or, depending on how much risk is across the board. So at the moment, I'm only 0.5% risk total. So I've got 0.5% to sort of work with. I like to just kind of aggregate my risk around. And plus, just in case something else pops up, these are trades that I might be in for 1 to 2 days, potentially, because they're more swing
You said that like
positions.
that was going to be a long time.
Yeah, I'm not a big fan of holding trades too long, but um, the way I've kind of looked at these ones, so Euro Swiss in particular, I'm basically shorting it from this zone that formed in here.
Yeah.
So I have kind of jumped it a little bit early as I saw price rejecting in here. I got short around about 95. Where is it? I got short at 95.88. So a little bit lower than what I'd really like. So I'm only about 7 pips up at the minute. Um, so I've front runned it a little bit, but that's why I went with a bit of a lower risk into it as well, because I thought that if it was going to be turning a little bit before that kind of volume zone, then I want to try and, you know, maybe add another position in if it does kind of rocket back to the upside a little bit. So yeah, I try and if I know I'm going to be Euro sort of weak this week, then I'm going to go and look at sort of keeping my risk appropriate across the board. Also, I like to add to a position if I feel like I've got more information and I'm getting it and it's going the right way. I like to add to that. So I don't ever go heavy risk straight away. Because as well, if I'm wrong, then I'm not really going to be that disappointed either, if that makes
Mm.
sense.
It does. It does. But when you're holding a position for only like a day or two, adding to it when it's going your way, like what do you need to see that it's going your way? Just price going the way that you anticipated it to.
Yeah, so if I feel like the plan is playing out, if I feel like my expectations of that is increasing, then yeah, I would look to add into positions on any kind of rallies. So let's say, for instance, here the market at the moment is kind of giving me an idea of what's going to happen. Obviously, you don't know what's going to happen, but if we did kind of continue this type of price action where I start to get lower lows and lower highs, if we got a pull back into here, and I felt that this would be a good area to add into a position. I'm not saying I'm going
Mhm.
to add in with like loads more risk, but what it will allow me to do is almost use the capital that I've gained from the initial position. I will look to potentially use that as leverage then to add into further positions onto the downside. Only if it's really, really going my way, I like to kind of do that. Sometimes it's just to kind of try and compound that move that I'm expecting. Because like I said, if I've only gone in with 0.25% here of risk, then I've got plenty of time to add in a little bit of risk if I feel like it's going my way. I don't like to add risk straight away because if my stop loss was just above these highs and I had like a full 1% risk and I get wicked out of that, emotionally, I might try and get back in that. I might revenge trade it. I might try and get something back out of it. Whereas if I've gone in 1/4% risk and it's not gone my way, I'm less likely to do that. It's more for my psychology side of it. Yeah.
Yeah. Yeah, that's fair. All right. So you're looking at Euro Swiss franc, you're already short. You're looking at potentially adding to Euro CAD on a break.
If we see the market continue to kind of give this price action here, then yeah, I like the fact that we've built this sort of volume in here. So I would like to see it rejected. If we get that rejection, I like the idea of further downside.
And that's, I'm assuming, is going to. I'm not trying to question you here, but this is coming off
No,
as a very
dude.
question tone. But that's not what I'm trying to do. I'm mapping this in my brain as we're talking to it. Is going to kind of coincide with your oil analysis.
Yeah, so potentially, obviously, we're seeing oil rally quite aggressively. We're seeing natural gas actually rebound as
Which
well.
is, yeah, arguably why, and I say arguably because there's multiple factors to it, but arguably why the
Yeah,
Canadian dollar is finding so much strength.
yeah, definitely. Well, not definitely, but yeah, there's many factors around it that are surrounding it at the moment. But yeah, one reason why we are seeing that CAD strength is we're obviously seeing a little bit of upside in oil prices as well. We've rebounded down from these lows at $72, which unfortunately we didn't quite get the alert on to go for a long position. And again, we kind of rebounded through here and above $80 now, above this kind of area of consolidation. So looking like we're going to see some further upside here on oil. There's some demand coming out of the US. It's kind of like a summer rush for oil at the moment in the US. We're also seeing the demand coming in for natural gas as well. Temperatures rising significantly in the US as well, creating that demand for natural gas. We've also got the recent sort of EU sanctions on Russia as well. So, we've got this play potentially on I don't know if anybody in the chat trades natural gas. I don't know if anybody's been I had a really good run
I
on
do.
it last year.
I've traded natural gas a fair few
Yeah.
times over the past 2 years, so I'm listening.
Yeah. So we've got this really nice upward trend forming here on natural gas at the moment, and obviously, if there is demand for something, then the price could potentially continue to rise. So I'm actively looking for potential natural gas positions, as more so than probably the oil side of things. Although I did see that global inventories in oil did come in a little bit lower. So again, that's kind of affecting that supply demand issue. Looking at kind of oil prices, I want to see lower prices before I start getting involved with oil. I did
Mm.
really want to see price come back down towards this kind of $79 area. Obviously, had this huge consolidation. Say huge, a few days of consolidation here, building that volume, and I wanted to see price breach this area of volume before a nice little pop into that sort of 79 area for a rally, but we didn't quite get it in the end. Price remained supported towards that kind of $80 level. And now we're back above it. I like longs on oil above 80. We were back here. I was discussing that price below 80 was not good. We'll probably see downside price above it. So 80 is my kind of level to
I
start
like
doing
it.
business with oil. So
I
yeah, I
like
like
I
to
like oil. I like oil to 100, but anyway, we're gonna have to cut it short because we are running
yeah.
a little bit over time. We're cutting into the guys over on the London live trading floor. So, guys, I want to say a big thank you for joining us once again for another episode of Morning Briefing with your 1+1=0 hedge fund. And we're gonna take a very quick 30-second break, and you're gonna be joined with the very, very, very good-looking Rich and his co-parent today. I'm going to call him a co-parent. Mr. Jonathan Radlin is going to be joining in today. So, guys, we're going to take a real quick 30-second break, and we'll see you soon.
We want that money. I want the Lambo money.
You know what I'm doing? I'm fine.
140 for sure. The more you zoom in, the more aggressive.
There's Tim Cook hedging against that already. This is the New Zealand dollar US dollar daily chart. Technicals, right? Price action is a result of fundamentals.
Really good earnings today.
We're looking at Brent's spot Brent.
The money will like being super rich.
Good morning. What an intro that is. The very good looking Rich. I'd like to do one better. The exceptionally good looking Jonathan, who's just muted at the moment. We're going to get that unmute button coming in, and then the exceptionally good looking Jonathan, still muted. the exceptionally good looking and still muted.
God,
Jonathan.
here I am. Here I am.
How you doing?
Yeah, I'm listening to that intro. I'm like, well, what about me? What about me?
Well, sometimes
thank
beauty
you,
has no
Rich.
names, and it's just adjust this. There we go. So you've caught me a little bit off guard. I've actually come on the back of having a few days off. So this is my first day officially back looking at the chart. So I'm
Nice.
actually hoping that you can update me on everything Forex. What's been
All right.
happening in your world?
Yeah, I've just got back from vacation, so yeah, not sure what I can update you guys on. But yesterday, amazing trading day, and last time I were on here, I talked about how I was testing like a negative risk to reward, like I was experimenting with perhaps testing that, and so I did test it. Actually, I tested two things, like what happens if I take half an hour on all my trades. I go through my journal. What if I look at all my trades and I just take profits at half an hour, and then I take profit at 1 hour, and I saw that it's actually very profitable. Like taking less profits is very profitable, which I can't believe I haven't really thought about this. And I think you're the first person that really, I think when I talked to you like long time ago, like first time you were on the live stream or I was on here or something, you mentioned the idea of negative risk to reward.
Mm-hmm.
And I'm like, why haven't I thought about that? I've been in this industry for 7 years and I haven't really thought about negative risk to reward. So I'm like, I got to test that. And it turns out that the win rate is so high that it's quite profitable, you know? So yeah, I've tried it out and got like 85% win rate and up 2 or 3 R, which is like the same profits, like slightly more profitable than my swing trading, but I go from like 40% win rate to 80, which is like, yeah, I take 80, you know?
And what does that do to your drawdowns? How does that manage them?
Well, so the drawdowns are obviously much better. I mean, I think the max drawdown on the negative risk to reward, like because of the high win rate, the drawdown was actually much better. I think I had a max drawdown of, when I tested this, I think I had like 50 trades tested, and max drawdown was like 3R or something like that, which is not a lot. But what I noticed is I'm getting too confident with the high win rate. And I think, if for the people that have been following me for a while, you know that I'm saying, I know how to deal with my negative emotions, but I'm not very good at dealing with my positive emotions in trading. So if I get very confident, if I'm like, if I'm just very happy, that's way more dangerous than if I'm, fearful or greedy. So yeah, I'm getting that high win rate and I'm like, oh God, I'm the best trader in the world, And then I keep taking trades that are not part of the system,
That's the problem, isn't it? When you go, hey, I'm not just having an upswing. Trading's going really well, like way too well. So if your drawdown with this is kind of I guess this is where my mind goes. If your drawdown was only about 3R with this negative risk to reward, then if previously it was say 6R, would you agree with the idea that now you could risk twice the amount per trade as you are now managing drawdown to the same percentage value?
Yeah, that's the thing. And I've tested, half an hour profit and then 1 hour profit. And obviously, the taking profits at 1-to-1 risk to reward was more profitable. The drawdown was a little bit bigger, but it was more profitable. But the win rate, was about 10 or 15% lower. But I'm actually thinking that I probably want to go with half an hour anyway, because I can adjust the risk. I can basically double my risk. And by adjusting the risk, I can be more profitable. And I'll have the luxury of having like 80% win rate, which to me is like, that's a bit crazy. That's very high,
Yeah.
for someone used to have like 40% win rate in swing trading and looking for like, having loser, big winner, loser. It's a big mind shift because now it's like winning, big loser, winning. And like I see those winning, like the alerts from TradingView, like TP hit, and it kind of, yeah, it takes a while getting used to, honestly, because I've been spending years trying to become a good loser, and apparently I'm not really getting there. I don't really know. I'm a very bad loser, apparently. But I'm a very good winner.
So for the just a
Apparently, I
little bit of
like
context
winning.
to this, if you're a little bit newer to trading and you're not following what we're talking about like a typical R value, a measurement of what you win relative to what you lose. So if you say, hey, I'm going to risk $100, you would say that's one of what I'm going to risk. So one R to me is $100. Now, what Jonathan's talking about is so much of what we see online typically points towards, hey, if you risk $100, you should be trying to make $200 or $300 or even $500 from a single trade. So trying to make multiples of what you're risking. Now, Jonathan's had this idea and he said, well, what if I wasn't trying to reach for the stars on every single trade? What if I did put up $100 and I'm happy to take $100 or less? And I know a lot of traders, and the first time I come across this, I was like, this isn't, it was actually, I think, encouraged by the Scruffy Trader. And it was like, okay, if I'm to think about trading as investing rather than risking, if I invested 100, how much would I expect to make? Well, you often wouldn't expect to make 100, 200, 300. We wouldn't expect to be making like 100% returns, especially on a daily. So I started to do the same work Jonathan's doing. And I had this real mental shift of, hey, I can make 20, 30, 40, $50 almost every single day. And then it's like, I found the holy grail. I'm never going to lose again. And then you get a loss, and it's a big loss. It's much, much bigger than your winners. And it's this complete shift of, actually, does this fit me? And I think when you go through a drawdown in real time, you go, oh, I'm down 3R. That's now going to take me 6 trades at half an R take profit to make that back. And you realize, your expectancy, and it takes a little while to make them losses back. So it's definitely a mental shift. And I think until you've sort of walked a mile in them shoes, you'll have to then see, hey, how does this fit me? Because my mind immediately went to, hey, I got a 91% win rate at 0.17 to 1 risk reward. I'm going to bet the farm on this every single time. And when I do take a loss after 20, 30 trading days, I'm going to double down on the next strat. And that's the problem. It produced this level of greed that I never experienced within my previous trading, because my win rate was around about 63 to 67% at 1-to-1. So yeah, it definitely opens up an elevator of emotions, I think, that we have to navigate. What floor do we want to stop on? But very profitable. Very profitable.
Yeah, it's profitable, but I think I just need to get used to, managing those emotions of, overconfidence, basically. I think that's what I think. And honestly, I think that's always been my biggest struggle in trading, because like my trading is like, my trading has been, it could have been so much better if I didn't give all the profits back, after, a couple of good weeks. So not all the profits, but you see, if you look at your equity curve, you want to have like a 45 degrees angle. You want to see that nice, steady climb, right? But what I have is usually like I have 2 or 3 good weeks, and then I give back like half of that in 1 week, or even less than that, because I reach a level where I think, all right, everything's going good. I know what I'm doing.
Mm-hmm.
And that's when the market comes along and says, no, you know what? You have no idea what you're doing. I'm going to take your money to prove it, And that's always been my problem with all the types of trading I've been doing. And now it's even a bigger problem, because now I'm winning way more than I used to, which obviously increases the danger of reaching that level of overconfidence. And overconfidence is so dangerous, because you you let those positive emotions dictate what you're watching. Like you might be looking at a setup and it's like, the 4-hour candle, like, so this setup is based on the 4-hour candle close. It's going to close in 15 minutes. But because I have such a high win rate, I'll just enter the trade right now because, of course, the chances that this 4-hour candle will close, and give me a trigger is obviously very high. But the problem is that's not what I have 80% win rate on. I don't have 80% win rate on entering the candle 15 minutes before it's closing. So now I'm trading something completely different, right? Now on that particular type of trading, I might have a 15% win rate,
Yeah.
So it's difficult, right? It's really, really difficult to get to know your emotions, and get to know yourself and really try to manage those emotions. I think that's really crucial.
I love what you did there. The market doesn't often ask that politely and go, "Hey, you don't know what you're doing, and give me your lunch money." The market normally slaps you pretty hard when it does that. I remember I was on phase 2 of the bootcamp account, and I just couldn't lose. Oh, I couldn't lose. If you think, take your best winning streak, times it by 10. That's what it felt like to me. I was like, yeah, I just can't lose. And that one trade that I said, my 85% win rate, it's just me. It happens everywhere. It's going to happen right now. Watch this. And then I just put on a random order. And that was the one trade, just like Stephen is saying in chat, about losing 9 full 1 hours. And today was your 10th. It's typical. That was the one time that I took a loss. And I was like, oh, hang on. This isn't 85% win rate. What's happening here? As I was averaging into this loss, and it just grew and grew and grew. And this thing, I mean, it grew arms and legs, and it took a huge amount of the gains that I had made. And it was a great humbling experience because it made me realize, Rich, your trading edge gives you that percentage return over a big example, but it doesn't just give you that if you just enter randomly. I'll show you a good example. We'll pull up the charts. This was the last trading day that I was looking at on, I think it was like the 21st. So no, it was the 20th. So I took the Friday off. We were looking at the choppy price action. I was considering managing risk. Market was selling lower, and I was looking for a break and a retest into this price point. So I was looking for the market to pull back up and kind of sell off from this. Beautiful price action that I see very, very often is if you get a really good entry, expect the market to very often come back, clip your entry, take out all those break-even traders that don't want to lose, and then often delivers the move to the downside. So on Euro USD, we were in this as a long. I was actually kind of, it looks like Spider-Man has visited my charts here. I had 3 entries long, sat through a little bit of drawdown. I'll zoom in ever so slightly here. And we can see that the market pulled back up close to this price point. Now, this trade wasn't cut based on its own price action. I felt price could go higher on this. The reason I cut this was a cross-currency correlation play from GBP USD. Now, GBP USD was the one that I was trying to size up on. We had 15 lots on this, and I was looking for the same thing. Market broke lower, and I was looking for the market. If you look where these arrows are, go back, check Thursday's stream. None of these have been changed. I was looking for the market to basically pull back and sell lower. So I was holding Euro USD until I decided to cut the GBP USD long. And then I was flipping immediately into a short bias. So this is the trade history. I got long here, got a little bit early, sat through a bit of drawdown, market come back up. I said, I don't care about price or break even, but that's where I sold. And there was me coming in with like 3.5 pips saying, oh, well, let me just get out of the trade. And that was the move that delivered. So we were looking at this selling at 15 lots short, and there was me cutting at $450 thinking, hey, this is a nice trade. The market goes on and delivers over 70 pips. We're talking over a $10,000 winner. Now, this is kind of what you get with risk to reward that's negative, or typically my own experience of it, is you get these beautiful little rejections. You get these beautiful little reactions to the market. But I've never been able to work out, hey, is this a reaction or a reversal? And you've got to be willing to take those $300, $400, $500 winners and let go of them $4,000, $5,000, $6,000 winners. Because the reality is the market only does this probably 1 out of 10 times for me. But it always feels like, hey, it's going to do it now when I've decided to adjust my trading. So I'm curious, while I set up my chart and we do a top-down analysis on this, have you adjusted your trading already? Or have you decided, no, I'm just going to keep an eye on the stats and forward test this?
No, so I'm actually I'm in the like forward live testing stage right now. So I've done all the back testing. The statistic that I found through testing is so obvious that there's nothing left for me to do than just to adjust my live trading. Like it was such an eye opener for me that I'm like, okay, this is what I need to do. So I went ahead and I started testing this less profitable but higher win rate strategy, and it's been going very well. I wanted to just touch on something you talked about. So I've in my trading, I've had I've had the luxury of finding an entry trigger that works well, and I did that quite early, and I do think finding a good entry trigger is probably one of the most easiest thing to do. It's the stop loss placement and the take profit strategy that I think is and trade management. I think that's the most more advanced stuff. And so I've always had a very basic entry trigger, which is basically break and retest, first retest, and then bullish or bearish engulfing candle. That's basically it. So I've experimented a lot with my take profit strategy, because I also quite early understood that as long as I have a wide stop loss, I'm okay. I don't really have to have any very clear rules for stop loss placement. I just need to have a wide stop loss. That's it, to make sure that I don't get stopped out on these stop loss hunts or whatever. So I've focused on my edge. Like what I'm working on is the take profit strategy and the trade management strategy. And I've tried a lot of different things. And like you said, the big moves, the ones where the trade just continues and continues, you said that maybe it happens, once in 10 trades. And I think that's actually quite realistic, because what I've tested is a bunch of different take profit strategies. Like probably everything that you could think of, like exiting at 1R or 2R, or exiting 50% at 1R, letting the rest run, or moving stop loss to break even at 1R. I've tested a lot of different things. And what I found is that the idea that letting your trades run, the thing that everyone talks about, if you have a winner, you have to let that winner run, That has not been the case in any of my testing long term. I've never found that to be profitable, which to me is weird, because I've kind of it feels like I kind of grew up, I didn't grow up thinking that, but it's kind of feels like that's just such a big part of me, You have to let your winners run. Let the winners run, or else you're not a trader. And I've tested this. What happens if I actually let all my winners run? Well, I'm not profitable. It's that simple. So I think what we have to do is we have to understand it's not about letting your winners run. It's about finding a strategy that works for you, because your mentality and your personality will dictate the way you're supposed to be trading. I can't let my winners run because I don't have the right approach to do so. I've seen now that if I do the complete opposite of what I've learned, I'm going to be much more profitable, which is weird, It's a weird thing.
It's interesting we don't get more people talk about that, like that negative risk reward. And when you said that your personality will show you how you're meant to trade, like, do you know, for the longest of times, I used to add to losers. Like,
that's
poorly.
That's a great idea.
Yeah, no, terribly. I used to add to losers. And in its early form, it was known as martingaling. So for those of you that don't know, what we're doing is we're talking about, hey, the market is, we'll look at this trade that we're in at the moment. We're just selling Euro USD. We've got one.
Yeah, I'm going to take that trade, by the way. This is beautiful. This is exactly the type of trade that I want to be taking. I'm going to wait for the 5-minute candle to close though.
Okay.
So if you look at the 5-minute, if that's a bearish engulfing, or just a bearish candle closing like it is right now, that's a sell for me.
Okay, awesome. Right. Well, we'll probably let's see if we can get an 85% win rate together live on stream. Demonstrate this in real market conditions. This will be the one trade though that the market's like, you want 85%? Let me show you 85%.
Of course, yeah, I'll do this on demo probably. So it's gonna be a loser.
But I used to add to these losers like martingaling. So I'd put one lot here, and the market would go against me, and I'd go, well, this is a better price. Let me put another 2 lots, and then another 3, another 5, another 10. Before I know it, my losses were absolutely massive because when I did catch the turn of the market, I would only have perhaps one lot of 15, 20, 30 lots I was willing to add. Now, this worked brilliantly, especially when I was doing it around red news events. It worked brilliantly until one day when it decided that it's not going to come back. And then it didn't work very well at all. I made 15% return, a little over that, 2 months straight live market trading. And I thought, I got this cracked. This is easy. And the market very, very quickly margin called the account. So the reason I share this is because when I was doing this, what I didn't know was it was my personality was telling me, hey, guess what? I like to average into price. Now, technically, I didn't know how to do it. And martingaling for me personally was a terrible way of doing it because it didn't control risk and it didn't maximize the winners. Now, my edge in trading comes from my entries. If I'm getting a good entry, the market will pretty much give me immediate profit. It doesn't often go in drawdown if it's going to be a winning trade. So most of my winning trades, they're going to turn at my entry point and they're going to run. The problem is, why would I average into a trade that's now not doing what I wanted it to? So technically, I can leverage very, very heavily and aggressively with tight stops, and that's the most profitable way of trading. My preferred way of trading is to give myself a beautiful wide stop and to kind of build my orders and average in. And I've learned this kind of a hybrid approach of doing that, which I've been doing on my bootcamp account for probably the last year. And it's just getting better and better and better and better. But there's still the opportunity where we don't accept losses. There's still the opportunity where the market can say, hey, this looks good. And then it suddenly doesn't look so good. And now you're left with $300 drawdown and you go, my trade technically is now becoming invalid. But there's another level it could turn at. There's another zone. There's another reason for the market to roll over. And it's on those occasions where I've held the trades that it rolls over. And I think, that was my analysis. I'm lucky. I've nailed the market. But actually, sometimes it doesn't roll over. And I've watched many, many, many 50, 60, 70, 80, $100 wins get wiped out completely with a $600, $700, $800 loss as well. That's the reality of negative risk to reward trading. So it's good, but you got to know when to cut your trades. So did you get an entry on this on the 5 minute?
Yeah.
You
My
did.
entry is what is it? It's 72.97.
72.97. I see it. That is a very, very strange looking 5 minute candle with the wick to the low side there.
Yep. But that one is not. I actually entered when I had the 1 minute up, which is not even looking that much better. Let's see. Well,
I'm going to add into this. I think this is fine. I think we'll pull back a bit. Where's your stop loss on this trade?
you know that meme. You know that meme with the dog sitting in the house burning, and it's like,
yes,
this is fine, and it's kind of like the way I'm feeling right now. That's it's fine.
Wait, where's your stop loss? Is it on this 5 minute high?
Nah, the stop loss is
no,
the stop loss is way higher. It's 73.36.
73.36. Okay, 73.36. Yeah. So I'm gonna build orders into this with a wide stop. My stop's on 07.46. I'm just trying to work out, where am I wrong? Or where would I want to add to this trade? I think we can see a little bit of a pullback. We're coming close to this 15-minute order block, which is this last bullish candle before this sell lower and the breakdown to the low side. I think if we can hold within this kind of price point here, would make sense. And I was looking for an entry here, just in case we didn't quite go high enough. Now we're coming into this zone. If we break this is I think this is a very clear break and retest to the high side. As I said earlier, I had a couple of days off trading, didn't even look at the charts for a little while. So this is my first opportunity coming back into the markets and trying to make sense of the charts. And when you do this full time, day in, day out, you find that the market often creates these stories that you can follow along with price. And you come back the next day and you say, oh, okay, we've moved here, we've done this. And today it's like I've skipped like 3 chapters. So I'm looking at the top-down analysis on this on the 4 hour, and I'm like, okay, we've got this beautiful big sell-off. This is where I saw the market up until here. Market come down, couldn't break and close under this low, couldn't even wick it. And then the market has come up and started to create this bullish structure. We've gotten above this level here, which is where I'm looking at a 4 hour break of structure. Market's just oscillating around. And ultimately, for me, it's just sitting within this range. I think if I'm looking to long this, I'd want to, God, this is a wide stop loss. This is like a 50 pip stop loss. So this would be a scalp short. I don't think that I want to hold this for too long. Where's your take profit target on this?
Well, my take profit is at the 5-minute low.
5-minute low.
You know, on that candle we entered on, the very low. No, not like
So
the last 5-minute candle. It's at 72, 77.
72, 77. So, okay. So hang on. So you're looking for about a 2 pip move?
Yeah. So I'm just taking a very, very small. So basically I'm no, it should be 4 pips.
4 pips.
No, it should be it should be about 4 pips.
72. And how many pips are you risking for that? I'm just trying to work out, are you 0.5 risk to reward?
Yeah.
Okay. So risking about 8 pips to make 4. Have you adjusted your stop losses in this style of trading, or are your stop losses still remaining where they used to be?
So my stop losses is still where they were. So the only thing that I've adjusted is just the TP.
Okay, so commissions are still going to be around about the same. So no traders that have kind of looked at this and said, I can call the market to the pip. I'll go in with a 2-3 pip stop loss. You've got to factor in commissions when you're trying to risk 1 or 2%.
Yeah, that's the problem with that's the problem I've seen recently with this trading, is that commissions is way higher. Well, not higher, but it's affecting me much more negatively than it did before.
Yeah, because I think I worked out the commissions cost me about 0.4 pips based on my stop loss and my risk. So when I'm putting on a trade, if you turn around and say, hey, Rich, you're putting on, for argument's sake, 10 trades a month, I know that I'm paying like 4 pips in commissions.
Yeah.
And the reason I care about this is because that's my cost of doing business. So when I look and say, hey, I've done this back test, it's over a 200 sample size, I can look at that and say, okay, well, every 10 trades, I'm losing 4 pips. So every 100 trades, I'm losing 40 pips. Every 200 trades, I'm losing 80 pips. And I'm trading with a 12 pip stop loss. So I can say, okay, in 200 trades, I'm losing about 6 or 7 R in commissions alone. And, when we get to this sort of 200 sample size and we go, hey, guess what? I'm up 20 R. No, you're not, because you're going to pay 7 R in commissions. It's like, it's pretty easy to find a profitable edge. Then you start allocating poor execution, slippage, swaps, commissions, like spreads. Like next thing you know, it definitely it can add up. It definitely can add up. We're going to take an opportunity to put in another order on this price point. See if we hold this ever so slightly. I'm going to bring my stops just up to the same level up here. We're at 0746. So my stop loss is a little bit wider than yours. I'm not going to go crazy with this. It's this is kind of my Monday morning, so I'm still warming up to the charts. I definitely don't want to take $1,000 loss right in the early stages. We see GU's trying to break this high of the day. I see, and Dean says it looks like it could be a liquidity grab as well. So this is a little bit unusual price action. We've got news coming out at 3 p.m. UK time, so a little bit over, I think, 5 hours from now. And I'm think if I can see a break and a retest to the high side on this, it makes sense for the market to move higher on GU. Let's see if we can hold this high and see if this definitely, EU looks better for a sell. I think GU looks better for a potential breakout and retest to the long side. Just looking at this high of the day currently and just watching to see if the market would do that and push.
So I had a comment here from Des saying if can you not just do the same strategy on higher time frames and therefore kill off the impact of the spreads. And that's what I'm doing. Trading like this, like I did on EU here, is not really the way I'm normally trading. Like this is a low time frame, almost. Well, I guess this is kind of like a scalp trade, and trading like this with the way I'm trading is long term not going to be very profitable. So what I'm doing is I'm saying that I just got stopped out. So what I'm doing is I'm taking my swing trading approach and I'm using the same entry and the same stop loss, but a much tighter TP on my swing trading, and that's based on like the 4 hour or the basically the higher time frames. And when I'm trading like that, the commissions isn't really a huge problem because I'm usually risking like 40 or 50 pips stop loss, so that's in that case it's not going to be a huge difference. But if I'm scalping like this, I mean, I've tried develop quite a few scalping strategies where I'm trading on the 1 minute, and I've seen that commissions and fees, and especially the spread. Now with the fibers, the spread is almost non-existent, right? Which is great for scalping. Mm-hmm. But if you're trading on if you have a personal account, then the spreads will become real problems. So the spreads and the slippage and the commissions when scalping, when you're only looking for like 5 to 10 pips, it's going to be a huge problem.
Yeah, the trading conditions on this scan we're using here is excellent. I mean, we're talking like 0.1 pips typically on GU and EU. If I pull these up, where we go, Market Watch, this is it's easy to get caught up in all these spreads being 0.1 pips. We've got EU here pretty much sitting 0.1. GU will be down here somewhere 0.1. We'll get little fluctuations on this from time to time, but because the conditions and the spreads are so good, it's very easy to go, I'll just put in another entry. I'll just put in another one. I'll just do another one. Oh, a couple of pips profit. But the commissions start piling up. I'm not sure I'd even want to look at the commissions on this. Let's do it. Let's actually have a look. We'll go all history. Let's go down. Yeah, 2,500 or 2,300 in commissions.
Wow.
That's I've been busy. I've been busy on this account for a little while. So that said, we're filled on 2 entries at the moment. I'm looking to size up on this. I've got one last price point that I think that will be an interesting one to try and sell EU lower. If the market breaks and goes higher, it's told me everything I need to know about the price action for the day. So zooming in on this, just looking for this beautiful selling pressure. I've got 6 lots sitting here as a limit, a sell limit. If the market wants to come up and tag it and then move lower, brilliant. If it doesn't, then I will be swapping my bias. So we spoke about this previously, that we can put fibs from lows. No, we don't. We go, let's put the fib from this high, this swing point up here. I'll zoom in slightly. So we've got a fib on this high. We're going to bring it down to this low, and then anything above the 50 would be a discounted price, I believe. So we can look at this and say, where are we? 1 second. There we go. We can look at this and say that I did sell just in front of the 50. It's not the end of the world. If your trading edge can accommodate it, you can still be profitable trading in front of the 50 retrace. It's just not optimal. There's a reason why I went for a couple of smaller orders, sitting at 1 lot each on these, because I'm just kind of getting a feel for the market, putting in orders that just to get an idea on how the market's moving and keeping an eye on price. I find if I've got orders in the market, I watch the market so much closer. This now is like an indicator of price. Watching this P&L at the bottom, just minus $50, minus 60. When I see this spike, it gives me a feedback that I think just triggers much closer than just watching candles bob up and down. I think I can watch these candles and become almost immune to them. But if I open a couple of orders, I can get this feedback that it's on a slightly deeper level than just watching price action. Do you ever do that, or am I the only one? I've spoke to Jordan about this. He's like, no, I don't do that.
No, never. Like I try to ignore the P&L as much as possible. I think watching P&L live like that is I think for most people not a good idea. I think you could maybe look at the tick chart if you want to have that sort of direct live feedback from what's happening. Maybe look at the tick chart in MetaTrader will give you that. But other like watching price, I don't think that's not for me at least. I'm watching EU, and I this is something I talked about yesterday as well. So, and also one of the reasons why I wanted to have a fairly tight stop loss on this one is the fact that we are seeing. I mean, we are at resistance, but on the 4 hour, I think that double bottom. Even on the daily, we have that double bottom, and we have quite a few news events coming out this week that can act as a catalyst. My most likely, the trade idea that I have is a break and retest of this high time frame level. Yeah, I'm gonna, let's see if I can share my screen. I completely forgot about that.
So we're looking like what, the 4 hour lows, maybe like a break and retest of the lows. Maybe the news can wick the lows to the downside and then continue lower.
Let me share my
interest.
Let me share my screen here, and I'll see if I can. Is it trading? Did I share trading view?
Not just yet. Hang on. Yep, I believe we can see trading view at the moment.
All right, beautiful. So what I'm seeing here is on EU, we got these lows. I'm watching that as a double bottom, and usually when I see a double bottom, like big one like this on the 4 hour, and we have a major resistance level right here, what I'm seeing is, like, for me, the most probable, not the most probable, but for me the setup that I'm watching is like I don't want to short this, because usually what I only really want to short the first retest. So now, of course, I did short this, but on the lower time frames, and on the lower time frames, it was actually the first retest, and it was this break and retest that I shorted. So basically, that retest right there was the short. So, but on the 4 hour, we've already tested this level. Now, I did short that move. Unfortunately, I got stopped out on that wick, and then of course it ran down to profit. But that's the first retest. So we have the first retest. Now this is the second retest. I only want to trade the first retest. We got the break and the retest, and now we're doing the second retest. So what I'm thinking when I see something like this is a W, and then what I'm looking at is a break and retest of the neckline of the W. That would be the breakout. That would be the first retest, and then the targets would be this region up here. So this is the way I'm trading. This is my swing trading strategy, if you will. And so I will be putting an alert at, let's adjust this level a bit. Probably, because it's an old level, so I probably have to adjust it to current price action. Should probably have it down here, something like that. So what I'm going to do is I'm going to have an alert here on trading view. I'll go in and I'll type look for longs on first retest. And then I'll put one alert down here as well. Let's see. Why can't I move that one? That's weird. Okay. So I'll put one alert down here. And that's just going to alert me to kind of look at EU, because maybe this idea isn't validated. And then for targets, I'm going to be looking at the daily. And it's going to be that level right there. Quite like that level as a target. And then I'll move it down a bit just to make sure that I'm not on even numbers. I'd like to put it probably at 7 or something like that. Now what? Maybe we can put it even lower at like 90, 94. Feels good. So we get the breakout. I get alerted. I put in orders here, TP here, and then the stop loss will be based on whatever price action is prior to the breakout. So if we get something like this and then the breakout, then I can put my stop loss here. But now, because I'm just looking for a very small move, like this could be a good example of a 1R, somewhere between 0.5 and 1R. So that's the idea I'm looking at on EU. And if price continues to trade in this range, I'm not really gonna I'm not really going to care much about EU because I don't like trading within a range. The whole idea for me is to only trade the first retest, you know. So that's also why I'm a little bit cautious selling EU based on this price action. I mean, yes, on the lower time frames, you did have the break and retest of this level. So for me on, see if I can adjust this level here, the break and retest of that level, especially on the lower time frames, now that looked like a good setup, you know. Of course, that wick is not perfect, you know, but it's still a decent setup. But now that we're above this level, I don't really see a trade here because now we're back inside this range and we have multiple, like we have this resistance support level that we need to go through before I can short this. But again, I'm not going to be able to short this because it's not, like when I see a double bottom on the 4 hour, yeah, not going to short it.
That's a nice chilled way of trading. Like, I like how you just setting alerts. You just wait for the candles to come to you. You're not sort of forcing anything. Trading's what you make it. And I think that for a little while, I made trading a pretty stressful game. We're just seeing that we're turning a little profit on EU at the moment, just starting to pull back now. Close to break even on this. And I spent 2 years trading 1 minute charts. We talk about commissions stacking up. And I did it because it was profitable, but it was a really, really rough gig. You could go through a month and you could have like 20, 25 hour month. And then you'd go another month and you'd lose 5 or 6 hour. Look at the swings between like the high side and the low side. And after a while, I started to say, do you know what? I think I'd just take like 5 or 6 or 7 hour a month if I could get it, like every month. So I went through the 1 minute charts and I spent silly amounts of hours. I was like, how can I make this consistently more profitable? And you know what it was? It was high time frames.
No.
That's the only way I could do high time frame filters.
I feel like, you know, for me, I think most people start with the low time frames because they think like the more trades you take, the more money you're gonna make. Like if you can take 2 trades swing trading, you can take 200 million trades scalping and you'll become a millionaire, right? It's simple, you know. I wanted to show you guys this. This is a picture perfect, like almost picture. Well, actually, I think it is. Like almost a picture perfect swing trade here, where you could be looking at this and you could say that, is it a range? No, it's not really a range. I think what I'm watching is this level. Okay, so we can go to the weekly. So I'm always doing my weekly trade planning on the weekly, and then I go to the daily, and then I look for entries on the 4 hours. So what we see here on the weekly is a break and the retest. First retest of a major high time frame level. Get a weekly. I guess that's a pin bar, like a weekly bullish pin bar ish. And not only that, it's also testing the this area right here between the 0.618 and the 0.786. I'd like to call that the reload zone, or whatever you want. But that's the long RL said, or the reload zone, and that's the level that I look at entering inside, because I've seen that on the high time frames. Most markets tend to have a very strong reaction inside this area. So if you can get it's like you talk about the discounted price. When price is below or above the 50%, depending on if you go long and short, you can watch that as price being discounted. I view this as the best entry area, where price is discounted. If price goes below this area, I'm not really interested in getting in. I only want to get in if there's a reaction inside this area. And this is a perfect reaction, right? It's a weekly level. We also have on the daily here, we have a really solid reaction here on the daily as well. I like how we have lower highs and lower lows. We still have lower highs. The best case scenario would be if this high would be lower, and then this would be like equal highs or even higher highs. And if we would have like a double bottom in here, that would be absolutely perfect. So the best type of setups that I see are the ones where you have this type of price structure, where you have a double bottom inside the reload zone, and that's going to be your entry trigger. But now I'm actually looking at this and I'm thinking, for me, this looks like a long. So if I would be entering here, I would want to take profits at like that little wick right there. And what happens if I have stop loss here? It's a wide stop loss. That's a 0.64 hour trade. It's still profitable. And it's a very wide stop loss. I think that's a 70. Is that should be that's a bit that's a wide stop loss right there. So now we start talking about swing trading with a negative risk to reward. I can go into the 4 hour, and what we see here on the 4 hour is a big move. Like we have this support here, a big move to the downside, fills up that whole reload zone, and then we reclaim that support once again. And in 11 minutes, we'll have a nice bullish 4 hour candle, and that's probably going to signal to me that I should be entering this. Now, the best case scenario would be if I had entry orders like right on the retest of the 0.618, because usually I see that a lot of times prices will come down into the reload zone like this, and it's going to bounce in here, and then it retests the 0.618. It happens a lot of times. Sometimes I add the 50 and you'll get that on the 50 as well. If price action is very tight, you'll get something like this where you retest the 50% fib. But this to me is like the perfect, this is just the way I'm trading. You get a level right here, like this is support, and then you have that breakout like that, and that's going to be the first retest, and the fib is then drawn from the low of the breakout move to the high of the breakout, and then the horizontal level needs to be in confluent with the reload zone. And there's like this happens all the time. Like it's you guys watching, you can just go out in the market, add the fibs, and you'll see how often the 0.618 gets retested. It happens so very often. You can even look at like some random downtrend. You can pull up Euro NCD, and we'll just look at all of these moves to the downside. Like probably that's going to be the reload zone right there. Add that one, and you see perfect reaction inside that reload zone. You can put on. Well, okay, maybe not the best example, but you get what I'm saying. It happens quite often. Very, very often you'll see that reaction inside those. So the fib tool is very, very powerful. Actually, I'm in a long on Euro NCD, and I'm all about transparency, so I guess I'll have to show this. This is technically a good trade, but execution-wise, a terrible trade, because I entered way too late. So first of all, it's not the first retest. It's like the 20th retest, it feels like. Now this is like 1, 2, 3, the fourth retest. That's not the first retest, but that's on the weekly, right? But what I really love about this trade is the fact that you have, I think we can look at the 4 hour. You have a very good looking downtrend here. So you have a downtrend into a high time frame level. Okay, so that's the weekly level down here, high time frame level. And then what we have is, I think maybe it's clear on the daily. Yeah, I think it's clear on the daily. So we have lower highs and lower lows, and that is like the first higher low. And what I do is when I see something like this, so I view this as a double bottom, but it's not any double bottom. It's a double bottom with the right leg of the double bottom, or the W, being higher. So it's sort of a double bottom, but with a lower low, and that lower low is inside the reload zone of this move. And that to me is the perfect like indication of this being the reaction that I'm looking for. So you have a break of structure, and that break of structure is the higher low, and the higher low is also inside the reload zone. So my entry for this should have been that 4 hour candle right there, when it, again, look at how it retests the 0.618. Remember how I said like it usually retests to 0.618. If you go into the lower time frames, you'll see the break and retest of the 0.618 right there. And that should have been my entry right there. And this is usually how I do my swing trading, and stop loss is going to be below the double bottom. And now a move up here all of a sudden turns into 2R, which means I can target the FTA, which is here, and that's going to give me above 1R. And now, seeing that taking trades that are 1R is highly profitable, I can have a TP that's just down here, which means I would probably already have hit TP on that one.
It's less time in the trade as well, right? Like you can just genuinely be in the trade less.
Yeah, exactly. And you know, I think you know, the timing aspect of swing trading is a real danger. You know, the more time you spend in the trade, the more dangerous it becomes. Right, the more problems might arise. You have a major news event, you have whatever happening around the world with macroeconomics. It's so the less you can stay in the trade, the better, in my opinion, because time is also a risk factor. Also, it's easier on your mentality, you know, the idea of getting in and out quick. So it's almost like you're swing scalping, you know, which is, I think, for me, that's just the perfect mix. Wide stop loss with tight TPs, swing scalping. I just invented something new right here.
I was sitting there thinking that's unique. That's unique. I get the impression when you were on your vacation, you were sitting there going, how can I adjust my trading? What swing scalping? That's what it is. I need to be a swing scalper. I need to be a super swing scalper. Jonathan, I want to ask you, you've got like this reload zone concept that you're talking about. Where did you discover these themes in price action that you're talking about? Did you learn them? Did you just spend time on charts watching them yourself? Where did you pick up the information that you use to interpret price movements?
So when I started trading, I started trading the crypto markets, and there was this crypto trading community back in 2017. I joined that, and there was this guy in there talking about this zone, this reload zone, and that was the very first thing I learned in trading, and I went through price action. Now he traded this in a different way, but what I saw is that price really respects these levels, and not only the 0.618, but this whole area below. So I looked at simple price structures that could be repeatable within the reload zone, and I saw that a double bottom within the reload zone, or the reload zone, like in this case, being part of a double bottom, where I basically started looking for patterns, and I found simple things, like price structure patterns, like a double bottom, and candlesticks. So I found that I've tested a lot of different candlesticks, and I basically asked myself, what candlestick formation is the most profitable within the reload zone? And then I tested that. I back tested that. And I'm talking about months of back testing, like just insane amounts of time spent looking for the best candlestick pattern. And I found that there's two candlestick patterns that basically almost encapsulates all others, and that's the bullish engulfing and the pin bar. If you understand the bullish, if you understand engulfing candles and the pin bars, you understand every candlestick out there. Basically, is what I believe. And then also Victor taught me the outside bar, which is, I'm adding that as the third one, right? If you understand those three, you understand all the candles out there. And if you understand,
give us an example on your chart of what those three candles would look like for those that are kind of not familiar with those names.
Yeah, okay. So I can look at we can look at, if I'm going to give you the engulfing ones and the pin bars. So we can look at Euro. Look, Euro NCD here. No, which one was it? Was it a Euro NCD? I had a chart up. Just I could swear that I had a setup up where I had a weekly pin bar. That's weird. Anyway, this is a pin bar. So that one right there, that bullish candle, that's a pin bar. So basically what you want to look at, a wick that is, I think the definition is that the wick has to be more than 50% of the body. So the length of the wick has to be more than 50% bigger than the actual candlestick body. And it's going to be a small wick on the top and then a big wick at the bottom. Basically, what this is telling you, there's a lot of buying pressure here, right? The candlestick opens, and throughout the time of this candle being open, there's a lot of buying pressure coming in and pushing price higher, giving you this big wick right here. So if you're looking at this, you're going to say like, there's a lot of buying pressure right here. This is a bullish, bullish price structure. And the idea is that if you understand the pin bar, you can look at this chart and you can identify the buying and selling pressure by only looking at the wicks of the candles. And then, of course, the bullish engulfing candle is going to look like this, where you have one bullish candle completely engulfing the previous one here. And this obviously tells you that there's a lot of buying pressure. And if you know these two patterns, you can, because I think these two are two of the most common candles as well. And if you understand these, it's going to be easier for you to understand, read price action. So here, for example, you could have if you remove this wick right here, you have like a sort of like almost like a bullish pin bar, but it's also an engulfing candle. And I think this would be a outside bar, right? When the wick, when it engulfs the whole candle, you have the wicks and the body engulfs the whole previous candle. So it's like if you remove that wick, you'll only have a pin bar candle, but it's sort of like a pin bar candle and the bullish candle at the same time. So I'm kind of losing my train of thoughts, but
what about an outside bar? Like if we're going like an outside bar, we've got an engulfing, we've got a pin bar. You said Victor spoke to you about like an outside bar. Is that not an engulfing? Are they two different things?
So an outside, yeah, that's the thing. And honestly, I'm a bit confused over the concept of engulfing candles and outside bars, because in my book, it's the same thing. But I think a bullish engulfing candle doesn't necessarily have to be an outside bar, but an outside bar is always going to be an engulfing candle. The difference between an engulfing candle and an outside bar is that the outside bar engulfs the wicks as well. So this one right here, that's an outside bar because it's going to engulf the wick of the previous candle. This can be an engulfing candle, this one right here, but it does not engulf the wicks of the previous candle. So an outside bar is basically just a stronger engulfing candle. So I guess if you know what a engulfing candle is, it's easy to understand what an outside bar is. So there's some confusion, but I think you can think of it in terms of engulfing candle doesn't necessarily have to be an outside bar, but an outside bar will always be an engulfing candle as well. It's basically just an engulfing candle with slightly different rules, where you have the wicks, you take into consideration the wicks as well. So you can see here, this is a bullish engulfing candle, okay? And it engulfs the previous candle. But if you had wicks down here, that would be an outside bar, because it takes out the whole bar, basically.
Okay, that makes sense. I want to do something in chat quickly. So give us the first pair that's mentioned in chat, I'm going to pull it up on the charts. I'm going to run through an example of a trading strategy I learned about 3, maybe 4 years ago, and it incorporated what we're talking about: bullish engulfing candles, bearish engulfing candles, and outside bars. I want to run through some examples because there were some really, really interesting results about how the profit was produced from this strategy. And I made a super interesting discovery on it. Let me just so as soon as we get something in chat, as soon as it gives a pair in chat, I could pick EU, I could pick GU, I could do it nice and simple. But I want chat to give us it can work on any asset class as well. So first one I hear inside the chat is that's what I'm going to pull up on the screen. EU. Paul, you went straight in there with EU. I'd say not the easiest, but all right, we'll do EU. We're on the charts anyway. Let me get rid of this because it's going to get me in trouble. So I'll pull this down slightly. We got 10 lots running short on EU. We got 5 on GU. We'll see this floating around at the bottom. Now we're going to go to a 15-minute chart, and I'm going to go just back to a random date where my orders aren't sitting there in the way of price. If we can find that, it just seems like we want to be on the way all the time. There we go. So we've got some nice, I'd say nice price action. We've got some price action here. I'm going to zoom in super close. Now, an engulfing candle was the entry criteria of a strategy that we were taught. And we used the TDI indicator, we used a moving average, and all we were looking for was the market to pull back. So show a directional move, much like this. We were looking for the market to pull back, and we were looking for the market to then create a candle that closed under the moving average, and we were trying to follow the trend. So what I noticed on this strategy, and it was the mentor was teaching everyone this strategy, and in typical fashion, I went off and did about 200 hours of back testing, and I was like, I can confirm your strategy is profitable. He's like, I know it's profitable. I was like, yeah, but I've gone off and confirmed it. Like, it's always good to have a third party look at your trading style and say, hey, guess what? It's profitable. I said, but there's this rule or something that's happening in your results, because he posted all his results. I said, and you're taking trades that aren't valid. And he explained to me this concept of a second leg. And it was often where the market would sweep liquidity and then produce the direction candle that we were looking for. And after 9 months of trading this live, all the profit came from these second leg entry candles. And they're super interesting because they were what has previously been explained to me as a magic candle or an outside bar. So if we look at an engulfing candle to me would be a candle that, like this candle here, it comes all the way up and then it just completely engulfs the previous candle. Any candle that closes above or below the wick, we were taught were engulfing candles. Now, this could be different depending on how you interpret price. And that's the cool thing about price action. If you go and study your strategy, you'll let the results tell you how to read price. There's nothing worse than saying, well, I think gravity works this way, and you keep just falling on the floor every day because it's going to work how it works. And it's the same with the market. It's going to move how it wants to move. Now, you can either say, hey, I'm going to try and interpret and learn how it moves, or if you sit there and go, I'm going to be rigid, the market will very often keep breaking your trading strategy again and again. So a magic candle or an outside bar to me was where the wick would come higher than the previous candle and close lower than the candle as well. So we're looking not just an engulfing candle. So this candle here would be an engulfing candle. The reason why is because it completely engulfs this previous candle and it closes here underneath this low. Now, the difference between an outside bar, and I might be completely wrong with this, is where the wick gets above the previous candle. So if this wick had gone above this previous candle, we could say, oh, look, we took liquidity from this high, and then we've got huge amounts of selling pressure because the market has not only wicked the high, it has pushed and closed below this low as well. So these types of candles are very, very good directional candles. When you can identify there's selling pressure in the market right now. Another one would be this candle here. Notice how this wick here gets above this high, and then it closes all the way down here below this low. And it's just looking at this candle close and saying, hey, there's active sellers in this area right now. Now, what you do with that is completely down to you as a trader. You can look for a break and retest and say, hey, I'm going to identify this candle here as say my entry candle, and I'm just going to mark it up. As soon as we break structure to the low side, I'll look for a retest in this zone, and maybe the market will come back up and retest and move lower. Maybe I want to enter on the close of this candle. So there's so many different ways that we can interpret this price movement, but they're very, very, very good directional candles. I was trading, I think, 24 different currency pairs, looking at the hourly candle closes, and the market would often give an engulfing candle. I'm going to see if I can see an example. Something like this, where the market would give an engulfing candle, get traders interested in the market, saying, hey, this is the breakout. And then the next candle would have this beautiful long wick, taking all the lows, then close bullish above the high as well. And we found that that's where we made all the profit. Like all the profitable trades were made consistently through that as well. And I became really, really good at recognizing like when these candles were apparent. And it's like, I think when you talk about the reload zone, engulfing candles and pin bars in themselves, are they valuable, or is it only when they're used in conjunction with a higher time frame zone? What's your experience on that?
Honestly, I've never tried it, but it makes sense for it not to be very profitable in of itself. But I think that to me is just the logical way of thinking. And if you only get a bullish engulfing, that should not be bullish at resistance, like you have to have a context. So for me, getting a bullish engulfing just in the middle of a move, like in the middle of a trend between support and resistance, that means nothing. But if you have a bullish engulfing on the retest of the 20 EMA, major support, the 50% fib or the 0.618, that's when it becomes important. I think us traders, like as traders, we're kind of like confident hunters, right? We're looking for confidence. Yeah. And that's so like when I say the bullish engulfing candle or the pin bar, when I'm not saying, just buy when there's a bullish engulfing candle. What I'm saying is like that could be a good ingredient in your trading system, but it's all about finding things that work together. Like for example, I found that if you have a bullish engulfing candle and a stochastic RSI bull cross, that can be profitable in of itself. To compare those two.
Okay, I like that it's super mechanical. Like the candle closes are super mechanical. We didn't have to search far actually to find an outside bar on EU. If we look at this candle here, we've got this beautiful wick on the 15-minute that comes up, takes this previous high, closes all the way down bearish, and look what the market did. Followed through all the way to the downside. So this was a 10 pip move. I mean, if your stop was above this high, they're going to tell you all the information you need to know that you're wrong about timing the market. You're looking for selling pressure right now, and the market moved lower. If this candle here, I'll zoom in ever so slightly, if this candle on the 15-minute that's printing right now on Euro USD in 5 minutes from now closes as a bearish candle under this low, we would see exactly the same. The market has come up, taken the wick from this high, and produced a nice amount of selling pressure. So if the market closed right now, that would be potential confluence that the market may want to continue lower. Nice and easy way of reading price, super mechanical as well. You should be able to look at 100 examples of this and produce 100 results that are the same every time you do that test. We're seeing a nice bit of selling pressure coming in EU at the moment. It's a little bit frustrating. I've got 10 lots on this. I was trying to go in with 15. You can see at the top left, I've got 5 more lots allocated. I wanted it just above this high. I was a little bit too slow. So we're just going to float around. I won't add to it now. We've got 5 lots on EU running short, $200 profit, around about 4 pips. And we're about 470 on the day. Entries are easy. Stop losses are easy. Exits are more difficult. So I'm just looking at this now and I'm saying, if I was selling EU, not if I was, as I am, where would I take profit? So we caught the entry. We've got this beautiful, nice rejection right here. We've got a 6-lot trade on the high, a couple of lower orders. Market's now pushing lower. We're about $500 in profit. Now, I'm just kind of looking at this thinking we could probably target these lows. Now, if I went in here with 10 lots, target the low, it's another, there it is. Let me see what's, okay. Market has just triggered my alert on GU. I'm going to go ahead and close all positions. very, very long-winded story as to why I'm going to do this, but I was looking for a break and a retest on this. It failed. We get this beautiful bearish candle. I think we will pull back into this price action and go higher. I don't want to be in the market when it does that. I'm looking for that quick, easy move. We found that this morning on EU. Yeah, I'm expecting the market could struggle through this price point. This is like 6 years of reading price action. To try and explain this in a 2-minute summary is going to be very, very difficult. Market produced a little bit of profit. I said, do I want $500 today? I said, yes. I closed it. Now, I do record different take profit targets. So I will record whether or not holding this trade for bigger targets is going to be more profitable. And it is, like, genuinely throughout my trade samples, the higher the take profit, the more profitable it is. But the balance is the lower the win rate, the less I can now risk, because the drawdowns are going to be more savage. Yeah, maybe this will be one of them trades that just sells off 70 pips and I'm the guy that took about 5 pips out of it. Maybe.
But you know, still, you look at the EU. It's quite messy. It's not really giving us any like super clear direction at this point. I think if I mean, if you go long here or you go short, you're basically, I mean, obviously, if you go short, you're betting on the fact that this resistance area is resistance. But at this point, with this price action, I'm not really seeing any confirmation of any of EU wanting to move in any direction, and that's what's frustrating to me. You know, well, it's not really frustrating. It's only frustrating if I take a trade in these environments. And it's only really frustrating if I feel like I need to take a trade, you know. Des is asking if you broke your rules. Did you break your rules, Rich?
No, my rules are
good.
they're a little bit different to what they used to be. My rules used to be look for this kind of, you know, structure shift, look for this kind of entry criteria. And I found that I was boxing myself in. And what I was referencing earlier when I said the market likes to move how it moves, just because I have a framework for that, sometimes the market would move in a way that I couldn't participate in, and it would leave me frustrated. So I said, you know what, just trust yourself. And so I created a trading edge called Trust Edge. That's it. That is my trading plan. It's called Trust. And it is this simple. When the market makes sense to you, you trade it. And so today the market made sense to me. I decided that I was going to trust my instinct, put my stop in a place where I'm wrong. That gives me the confidence to hold my analysis. And the trading plan literally says you record all your different various take profits, but you exit the trade based on your discretion, not the P&L, based on your discretion. So I followed my trading plan perfectly. The results I get definitely underperforms from having a mechanical take profit. So the entries are very, very difficult to replicate because I'm looking at multiple confluences. So if I went and back tested EU, I think it'd be profitable. The problem is I only have half the picture. So when I'm live trading, I'm looking at the Dixie, I'm looking at GU, I'm looking at other correlations in the dollar pair, and I'm saying, what could happen here? So many times, and I have never found a trader that can physically prove me wrong on this. So many times I've seen the market produce a point of interest where I want to trade from on one pair, and it comes in and clips that price point and just nosedives, completely turns around. And I've looked at other pairs and said, why have they turned around at those price points? And made no sense. And it made sense that they're correlated pairs to us to a degree, and that when the dollar's moving, it would drag these other pairs. And that's what I'm anticipating on GU this morning. I think that we're going to see a bullish pressure coming in from here, and I think the market could potentially go higher. Now, I don't want to sit if GU starts pushing higher and taking this high, even 10 pips. I don't want to sit through that on EU, because that's going to, you know, we see this little bit of buying interest coming in on GU now. Well, there's a good chance that that same buying interest would come in on EU, and that's going to affect the P&L of the account. So the technical analysis for me said, get out of the trade and then just record the results over time, and you'll see if you're more profitable. And I'm not more profitable. That's the frustrating thing. I'm more profitable if I just say, I'm just getting in, going for 1R, 2R, 3R. But my psychology says, Rich, there's $500 right there. Why don't you just take it? You've got a great rejection in the market. You've found a little bit of selling interest. Get out and get paid. And then I haven't got to sit through all that drawdown.
Yeah. I'm
Which I think full circle. That's what you said earlier. Finding how your personality fits your trading style and trading in line with that rather than trading against it.
Yeah, this it's so frustrating. Like, I told myself this morning, actually I told myself yesterday that like I probably shouldn't be trading today. And then I told myself this morning, I probably shouldn't be trading today. And now I really want to enter a trade. I feel like I kind of want to enter a trade, you know. I
What are you
like
gonna
this.
do?
I like this. Well, yeah, I don't know. Like, well, I'm not gonna enter trade. That's what I'm gonna do. But I know that this is like I don't enter trade, it's gonna hit that TP. It's like that's just a universal law of trading. Like that's the day when you decide not to trade, that's when you're profitable. But I like this price structure of USD CHF. So I'm trying to find reasons not to take this trade. But like looking at that weekly, we got that beautiful pin bar on the weekly right inside that reload zone. The daily, we're like I'm just the only problem I'm having with this trade because I just want a small move up to that side, but the stop loss is way too wide. So if this low would have been like up here, that would have been perfect. But now it's just not worth it. The risk to reward of this trade is just not worth it. I can't have the stop loss. Like that's going to be, it's going to be 0.36, 37. That's not going to be worth it at all. If I could have my stop loss here, that would be like 0.6. Then at that point, that would be worth it. But it's frustrating because this idea is from last week, right? Where I had on that Friday, actually the week, yeah. So that's actually the week before. Last Friday, I had a plan that said like something like this. I want to see it move lower, then reclaim to 0.618, and then move higher. So that's the plan, right? And the plan is playing out. And when you have a plan and you've been waiting 2 weeks for that plan to play out, you kind of want to take the trade. So why am I not taking the trade? But I feel like you have to also follow your gut feeling in a sense, because what I've learned is when you're trading and you're trading well or you're making mistakes or whatever, your unconscious will tell you things, and its language is emotions, right? So you kind of have to understand the emotions that you're feeling and why are you feeling those emotions, like why are you stressed, So usually what I know is like if I had a good winning streak and I start to feel stressed, that's usually because unconsciously I know that I'm getting a bit overconfident and I'm missing important details. I know that I shouldn't be taking this trade, but I'm taking a trade anyway. And it's like my unconscious understand this before I do, So the fact that I'm stressed over this trade is probably a reason not to take the trade,
But are you going to record the trade in your entry criteria and record stats on it and then record the reason you didn't take the trade? If it's a
No,
mechanical trade that meets your rules, surely it goes in the database.
Yeah, but it's not like this. This is just not. The price structure is a bit it's a bit different. This is not really what I want to see. I feel
Okay.
like this is not really what I want to see. I think the overall the biggest problem here is the biggest problem here, and the reason why I feel like this is not a good trade is that high, is that high in relationship to that low, and where I want to enter. Like if I would have my entry, down here, then absolutely that would be a trade, because then it makes sense. But now I'm if I would be able to have my stops here, then that would make a lot of sense, Or you stop to that level. That would make sense. But now having the stop loss here basically means I'm having my stop loss between two support levels, which makes no sense,
Okay. So like Barry says, every strategy needs context. Taking random bars in the middle of nowhere is just asking for trouble. Hard part is deciding the context. Is it a reversal? Is it a pullback? Is it a continuation move? Jonathan, when you're looking at that, it might be that the context isn't there. Now, I'm going to go on record and say, from my experience, the market doesn't care how I feel. The only thing that affects my results is if I feel a certain way and I execute poorly because of it. That could be greed, that could be fear, that could be FOMO. It could be a number of things. But the amount of trades, and it's not just personal to you, do not worry about it. The amount of trades I go, hey, I'm not going to take this. Market sells off. Oh, well, that's got to go in my data sheet now. Why? You said you're not going to take it because the context wasn't quite right. Now it's sold off. Now you've seen it's a winner. Now you want to put it in your data sheet because it makes your strategy look better than it is. If you put it in your
Yeah,
data
that's
sheet,
true.
now you've got to affirm the reason as to why you didn't take the trade. And the reason you didn't take the trade, Rich, is because you're actually a really bad trader. And then I start thinking about why I'm, using the word bad and stuff like that. And then we do that NLP work, and it's super interesting because the market just really, really doesn't care. For me personally, the market just is going to move and it's going to flow, and my job is to participate. When I'm emotionally compromised, I'm going to get it wrong more times than not because I'm not going to see what the market's doing because I have a bias, and that bias is like having a blindfold over my eyes, and I'm just completely ignorant to price movements, and it's the most dangerous thing. And I genuinely believe that's why trading is 90% psychology, because you can be completely emotionally compromised and you can have the best setup in the world right in front of you that goes against your trade that you're already in, and we won't see it. We won't see it until we cut that trade and we look back and we do a review in a neutral standpoint and we go, hey, that's that. No, why did I miss that? I do it all the time, and it just tells me my strategy works better than I ever anticipated. I do not have the mental psychology to execute on it flawlessly. So, Des, when you said that could be a very dangerous skill for less experienced people to rely on their instinct and trade, 100% agree. Took me,
Yeah.
I want to say, 5 years of full-time trading to even attempt to do this. And I did it in a very controlled manner. And the frustrating thing is the results, hands down, destroy any results I've had previously in trading. What does that tell you? That what I'm doing from an instinctual level is working very, very profitably. The problem is, if I now allow myself to believe that, I'm going to become overconfident and I'm probably going to ruin that trading edge. So it's the perfect balance of keeping ourselves in harmony within your trading. But yeah, it is what it is. I'm just looking at EU now, and it's probably no. I like that it didn't go much lower. I like this kind of stalling around this price point, and it hasn't gone much lower. Did just pull back ever so slightly deeper to catch your stop on that. Just want to see quickly. Des says, Jonathan, the pattern you see with the W bottom you trade, have you tried looking at Bollinger Bands with them? Are they a great tool for those patterns?
No, I think I've tried to include Bollinger Bands, and so first of all, for me, it's very important that I'm only using indicators that make sense to me. Indicators that I understand, I know exactly how they work, and they make sense to me. And the Bollinger Bands, while I know how it works, it doesn't really make a lot of sense for me to use it in my trading system. I've tried it a lot, and I haven't really seen any success with that. I don't think it. I think it's using the Bollinger Bands is more buying and selling the extremes, while I'm I'm looking at more of, you know, I'm looking at very clean trends. I only want to it's feel like if you're trading the Bollinger Bands, it's a different way of trading. And to me, the double bottoms does not work very well with the Bollinger Bands, because the Bollinger Bands are more like one touch and then you get in on that touch and then it starts moving. Um, that makes sense. Yeah, Rich, I wanted to ask you something. Have you seen? So I know that you're big on journaling and statistics and all of that. Have you seen any correlation with your mental state of mind and your profitability? So let me give an example.
Okay.
I know that if I start feeling a certain way, that's an indication of me not being in the zone. And when I'm not in the zone, I shouldn't be trading, because every time I do, the result is just worse. So I have a feeling that you're just following your systematic approach no matter what.
Maybe externally. Internally, there's a whole different conversation that goes on. It goes to something like this. I look at the price action. I say, "Hey, this looks all right. Yeah, but you're emotionally compromised today. You've come away from the charts. You're not looking at it for 3-4 days. You're operating on 3 hours sleep. You know, you've got a whole bunch of life admin to catch up on. You probably shouldn't take this trade right now." And then my mind goes, "Yeah, but it does look good, and the market doesn't care about how you feel. So maybe you should just enter." Okay, all right, I'll just put a small order in. Next thing I know, I'm now committed. And that's the quick way for the market to drag me up to my elbow. It just takes a finger, then it takes the hand, then it pulls my whole arm in. The best results I ever get is when I don't care about the account. When I remove the P&L off that pedestal and I say, I'm just going to turn up, I'm just going to rock up, I'm going to trade price action. The results are really, really good. When I got, okay, personal story. I got a live funded account. Got it funded, phase 1, phase 2, it, just traded my edge. Got it live funded, took 3 payouts from it, and I'm now sat in a drawdown about 1.5%. And 1.5% drawdown is nothing. I mean, I made like 13, 14% just get the account live and then multiple payouts. The problem is now it's like, yeah, no, this trade's not clean enough. I'm gonna sit out on this trade. I'll take the next one. But do you know what I will do? I'll go to the account I care less about and I'll just trade it on that account instead. And that account just passes, phase 1, phase 2. I think Thursday I passed another account as well. And I was like, I'm the master of trading accounts that are in challenge phase. And then it's like collection. I go to the auction, I collect all their cards, and then I finally get them live funded, and then I go, right, now they go in the cabinet and I'll never use it again. So yeah, put me on a practice account and I'm like the boss of it. But you put me on a live funded account and I always find a reason not to trade that account and just take it on another account. And the P&L has a clear reoccurring theme that the equity curve goes up. And so I build up these beautiful demo accounts again and again and again and again. I got too many of them with great equity curves. And then I've got this live account that's just sitting there like, yep, it's been 8 days. You haven't traded on me. What are you doing? So yeah, definitely, I think mindset comes into trading as well. So that's something I've got to be mindful of. And I'm getting better at it. Is this a valid trade? Yes. Oh, place 1 unit of risk on the correct account. And I now score myself to make sure that I trade on the correct account. So it's nice to have one account that's a little bit different that you can be a bit discretional on, but yeah, you definitely can end up using it as something that's a little bit of an armband, and it probably hurts you more than it helps you, even if it makes profit. But I'm conscious we've run out of time. Jonathan, I want to take a moment to say thank you ever so much for joining us on stream. It was a pleasant surprise on the Tuesday morning. We're going to take a 30-second break. When we get back, we're going to be joined by David and Aaron. Stay tuned.
Entrance music. He's got his entrance music.
I just got to remember what I was talking
Now they're firing
about.
16th of a pip.
No. So right, also fellas, milk some cows.
Hey,
All right.
We're gonna have some fun here on the stream for sure.
Good morning, traders. Thank you guys so much for joining us here at TradeDelicious. We're back with another episode of Not Buying It. I'm your host with the mostest, Aaron. Super excited to start the day. The incredible man to the left, the right of my screen, depending upon the orientation of your screen, is the absolutely incredible Duke of Dollars, the profit professor, the stock sniper himself. David, how you doing, brother?
Feeling really well, especially because I took an extra day off this weekend from trading.
Yeah, I didn't trade yesterday at all. Took the extra day off, and we'll talk about that a little bit. For sure. As we talk about being more well-rounded, got the chance to listen to the tail end of the London trading floor, talked about, where you're at either emotionally or physically, and does that play into your profitability? And for me, it absolutely does, especially if I'm scalping. I took the day off yesterday. Just wanted to make sure that I gave myself the time physically to kind of get over the weekend because I was up late. And so that kind of goes with the territory. So sometimes, you protect your account by not trading that day, and that's a-okay. But I've noticed I think along with a lot of people out there in the trading realm, have noticed a bit of a rotation starting to happen in these markets. NASDAQ stocks feeling a little weak, and some of these other stocks catching a bit a little bit. So we've noticed a little bit of that. And so it's going to be a not buying it episode. It's going to be really interesting because now I'm looking at things in terms of not necessarily portfolio building, but trades I could probably execute because I'm not feeling a lot out there that I really want to buy right now.
Yeah, and that's to be expected, right? We've gone up and to the moon. The markets are a rotational thing, though. What comes up, what's come down. Now, that doesn't necessarily mean that what comes up must come down to what it was originally. I think we get that a little mixed up because people say things like, these markets, it's too high. It has to go back to where it was at the beginning of the year or the beginning of last. That's not always necessarily the case. Markets do pull back, but we're oftentimes very surprised by how large or small those pullbacks can be. Speaking of a little bit of a pullback, speaking of something that we're so accustomed to moving incredibly quickly, I will volunteer as tribute for the first piece of this puzzle because I was really surprised when I read this. I want to talk a little bit about Palantir. It's a little bit of a darling in these markets. We've spoken about it, I don't know, 4 or 5 dozen times. It appears on the stream and on the show. We've talked about it quite a bit. Look, Palantir is a company that hasn't been around a long time. The IPO happened back in 2020. They've performed incredibly well. They did a great job of pushing the pace, seeing really crazy highs, $45 back in 2021. Since then, they've had a bit of a pullback, but they've seen an incredible amount of volatility, going as low as $5.92, going as high again as $45. It's trading right in the middle here, right around 24.16. The reason why I brought up Palantir and the reason why I'm interested in this kind of equity is the fact that Palantir was recently downgraded. That's not something we're accustomed to hearing for companies like Palantir. For those of you that don't know, Palantir is a custom software company that produces a lot of different software, primarily for commercial as well as government systems. They help companies organize data, which is incredibly valuable in today's day and age. Data is the name of the game, or so you would think. Palantir, as of late, has been downgraded by a number of different large banks, Morgan Stanley being among them. And it's odd because Palantir is a really great AI-based company. Last year, they released an AI product right in the middle of January as NVIDIA started to take off. And Palantir really recovered an incredible amount of their losses by doing so. It seems like that was the most brilliant decision that any company could make. The gentleman that actually downgraded them said something very, very fascinating that I'm going to talk about a lot during this little presentation. Most targets fell to like $20 as a target, which is about $5 less than what the equity is actually trading at right now. So it's not a great perspective. This particular gentleman called the valuation, he said that it reached a gluttonous extreme. There are different quotes. There are different quotes about what he actually said. So I'm curious as to how different outlets got this information. But I've read that he said that it's a gluttonous valuation. It's a gluttonous extreme valuation. Either way, gluttony is the center of the puzzle here. And there are a couple reasons why he would say something like that. When it comes down to it, of course, a lot of this is getting blocked, but when it comes down to it, the reason why he's saying that it's a gluttonous extreme, if I could get this article to work properly, is because of where the equity is relative to its competitors. We've also recently talked about Snowflake on the channel. We've talked about a few different software-based companies and where they are in perspective to how they've been performing. A company like Snowflake is performing at approximately 8.7 times its estimated earnings for the fiscal year 2025. When I say it's performing at that rate, that means that we are trading at its market cap valuation is about 8.7 times the amount of estimated revenue that it will bring in for fiscal year 2025, January over to December. What that means is the company is performing really aggressively. Having those kinds of numbers is very aggressive, but it's pretty typical for tech stocks. What Palantir is doing is they're performing to 17.7 times their estimated sales revenue in fiscal year 2025. That's 2x. No big deal, right? It's kind of a big deal. To be able to perform at those kinds of numbers, you need to be expecting some massive growth in your overall sales numbers, and they're not. They're expecting some beautiful growth, 23% estimated year-over-year growth in total sales for 2023. But if they continually lose again and again and again on their potential profits, it's on their potential profit growth. It's not a great sign, especially when there's so many competitors in the space. I know what you're thinking. Companies like NVIDIA are doing so well. Companies in the AI space are doing incredibly well. You'll see articles that look just like this. People are saying that they're doubling down on another quote unquote unstoppable artificial intelligence AI stock. This is news that just came out this past Sunday. So why is it that we're getting news that says things like, oh my goodness, Palantir is the way to go. 12% of my earnings is in NVIDIA, stocks that are relative to that. Why are we seeing news like that after so many companies have continually devalued the equity? It's because of a couple different things, and those things really center around earnings. They have performed super well from an earnings perspective as far back as June. All we've seen is green, green, green. But the negatives that we're continually seeing is net change in cash. Even when they perform incredibly well, net change in cash, we're still seeing hundreds of millions of dollars being spent. Thankfully, their income has continually gone up. So 28 million to 71 to 93 to 105. They're continually making more net. But as things continue to accelerate and as the competition becomes more fierce, it's a little nerve-wracking for some of us investors, because why would I put my money in a Palantir, a company that has a quote-unquote gluttonous valuation and not as much room to grow in their sales figures, looking at 23% over the next year, where a competitor like Snow is so much cheaper. And not only is it cheaper, but they're able to produce earnings over the next year that are over 10% higher. Their earnings are expected to go 34% in fiscal year 2025. All of these things play an incredibly important role. Now, you guys know how I like to do things. I like to talk about the actual numbers, what they actually produced, what their income and balance sheet looks like. I think this stuff is incredibly important. In terms of their revenue and their overall report, their earnings report in Q1, everything was pretty impressive, as you would expect. Income from operations, $80 million. Adjusted income from operations, $226 million. Overall guidance wasn't super exciting for Q2. We should be receiving some earnings data from them pretty soon on Q2. And it just wasn't super exciting in regards to the level of growth. In these types of companies, we're used to seeing double-digit figures in quarterly growth. That's not typical by any shape of the imagination, but was what we're accustomed to seeing, because NVIDIA's led the way, and in their guidance, they're not going to say things like, for our outlook, we expect to grow $10-20 million when they're doing 600 million. They're going to say crazy things like, we expect to see 700, we expect to see 800 million in revenue quarter over quarter. So as we see those kinds of numbers, it could seem like a great thing, and that could get a lot of regular investors excited because it's something that we are not accustomed to seeing. But for those of us that have been in information technologies, software stocks for a long period of time, this shows growth, but it shows a slowing of growth. And it looks like we're going to continually see this kind of performance where we're seeing growth continually slow down, which is crazy to say because their net income in Q1 of 2024 was 106 million. Their net income in Q1 just a year prior was $19 million. So they've almost 10x their net income. But sometimes when you accelerate how well you perform, you have to expect things to slow down just as quickly. Looking at the full breakdown of the equity, there's a lot of fun stuff that gets a lot of people very excited about it. Let me just cancel out of this guy. Of course, I've actually gone over my total reports. That's perfectly fine. The big things that you need to know about this particular equity. One, in regards to its overall performance, we are sitting at an area that technically looks pretty doggone good. If we're looking to swing this thing, I wouldn't blame anyone for doing so. My only concern is we have struggled, and I mean struggled, to continually remain above this level here, right into the 23s, right into the 25s. We've struggled to perform incredibly well. The level of volatility for this particular equity is something that has me a little nervous for my overall perspective on the market. And as we see the NASDAQ pull back, as we see NVIDIA finally slow down, as it's become the behemoth that we always thought it would, we have to expect equities like this to perform a little slower. In terms of long-term portfolio perspective, I don't think that this is the answer by any means. I do think that this could be a good opportunity from a swing perspective. It still has a lot of hype. I still think people are going to be very excited about it. But in terms of where we are relative to other opportunities, there's no reason why you can't trade a snow and make the same, if not more, than you would on a Palantir. There's no reason why the additional competition that's there in this space wouldn't be a little bit more valuable to your portfolio. That's where I would be focused from a long-term perspective. From a swing perspective, feel free. There's so many great opportunities. If this thing gets down to these 2050s again, if this thing continually consolidates around these 23s, there are great opportunities for this thing to move $1 or $2 if you're comfortable just swinging for that small amount. But since it's only $25, I'm sure you can afford a few more shares here. But in terms of actual day trading possibility, in terms of long-term portfolio possibility, Palantir, darling of the market that it was for so long, I'm not buying it.
Loved it. Love listening to your presentation there on Palantir. Palantir is one of those top stocks that kind of flows in and out of my day trading basket based off of the not so much the AI hype. They do have that conversation. It's kind of meme stock adjacent a little bit. A lot of the meme stock lovers tend to love the Palantirs of the world, and the chart is, frankly, self-explanatory. Gap up after the last earnings, held $20. That's your support in and around that $20. We haven't been back to $20. You got down to about, call it $20.50 into $21. And the range top being about $26.50 to $27. That's kind of your range. So it's a pretty clean chart on a 50 and a 200 moving average on the daily chart. That's pretty clean. It's not accelerating exponentially like the NVIDIAs of the world, but not every stock in the market's going to grow 1,200% in a year. When we talk about other things that aren't necessarily NVIDIA, we're like, oh, well, this has only done that. But yeah, these these kinds of stocks that have been in favor for about the past 12 to 18 months, you're going to see some rotation out of those things as we start to feel a lot of upward, kind of like getting real frothy in terms of tech stocks in the market. And we say, okay, where do we go from here? Not that anything's fundamentally changed, just that, okay, we've gotten to this point. What's the next thing that's going to happen? What I will say, moving beyond this next quarter, when we do get that next earnings call for a Palantir, let's see if it holds that $20 level. If it holds the $20 level, you know that that's a really good floor for it at this point, since we've held it over the past quarter, and now we're going to over the past couple quarters, really, and now we're going to use that as our floor for Palantir stock. So now let's talk about the next thing. Let's talk about something that has been in the news, directly or indirectly, more so directly for some negative stories, but kind of came up here recently because there's mergers and acquisition news that's kind of hit this stock. And I'm talking specifically about Spirit Airways. Spirit Airways is a parts maker. Used to belong to Boeing. Boeing spun it off a little over 20 years ago, something like that. They make parts for Boeing and Airbus, but now Boeing is looking to reacquire those guys again. So I like to do things backwards from Aaron. I think it took in terms of how we break these things down. Let's look at the technicals real quick first, and then we'll get into some fundamental talk a little bit. So here's the chart on the daily on Spirit. Again, overall, you look at it and you say, compared to an NVIDIA, not the sexiest chart in the world. And even with all of its issues, and what I mean by that is some of the news that we've had on Boeing, Spirit stock, pretty much since the year started, is up on the year. And so you can't really snub your nose at that. So if you've been in the stock since the first trading day of this year, and if you've been in the stock since last year, since those October lows, you look at it and you've made pretty good money on it. You've got you had a golden cross kind of happen towards the end of the year last year, and it's kind of held true to form, and we've kind of pushed up. We have double topped here most recently at about the $36 level, and you look at the price action, it does kind of coincide with highs that we saw a little over a year ago, April of 23. And we've kind of seen the price action really trailing off on it, getting close to the 200. But why it's back in the news is because there's news that Boeing wants to buy this thing back up again after all of the issues that it's had with quality control. A lot of times when Boeing says, hey, they say, Boeing, your planes are crap. They're like, yeah, we're having trouble with our supplier. This is the company that they're talking about most generally, is that Spirit Airways company. And they're saying, hey, yeah, we're having issues with our supplier, and we're in talks with them to work through whatever issues that we might have. So in terms of where it's at right now, on the chart, it's closer to the recent highs than it is recent lows. Even look at the volatility that we saw here yesterday, where we've kind of gapped down, sold off and then bought back up, and then still ended the day red. And now in the pre-market, we're back down a little bit. And again, very, very volatile stock. So why is it doing this? Well, there's a couple of different reasons why this stock is doing that. As I get to the right slide here. So Spirit Aerosystems, Boeing offered to purchase at $35 per share, but they don't want to use cash. They want to use stock. And so where it bumped up initially and said, hey, this is a really good deal, now they're saying, well, this isn't an all cash deal. This is not even a mixed deal. Boeing has been hemorrhaging money and has had its issues over the past, several months for sure. Boeing can't get it out of its own way in terms of headlines. And we did a segment on not buying it about Boeing. I think that might have been our first episode. I might have done a segment on Boeing. And so, we look at a Boeing, and now you look at Spirit Aerosystems, it's one of its main suppliers, and they're looking to buy them. But again, we're trading near where they're trying to buy them anyways, right? There is a premium over the current price, but now the investors, because we've been really trading stuff like the Nvidias of the world, like, well, we want 1,000% potential off of anything we have. Well, you're talking about 10 to 20% premium over the current price of the stock, depending on where it closes on any given day. And the other thing is that they don't want to use cash; they want to use stock. So I don't necessarily like that. It just doesn't make me feel good. And if I don't feel good in these markets, then that's not something I'm willing to participate in terms of like a portfolio holding thing. Now, you make it a little cheaper. You get me to some intraday support levels that make me feel good on a 30-minute or 15-minute chart that I can execute off of. I would love the opportunity to trade this, right? But in terms of like where it's at and then buying and holding through the acquisition, I don't necessarily know that makes me feel good. Again, issues with whistleblowers. I mean, there've been a couple deaths associated to this. Some of them were dismissed, but like the tinfoil hat, the sentiment around the company hasn't necessarily been one of those things that's very positive. And so now when I looked at this ticker symbol before I even opened the chart, right, I sat there and said, okay, based off of how I feel personally, the stock hasn't done really well over the past year and really hasn't necessarily performed. But realistically, 52-week change year over year, price change wise, it's gained 13% year over year in terms of a rolling 52%. So like, this is growing faster than the value of your money. We talk about savings accounts all the time. If you had your money in Spirit Airways over the past year, you've beaten that for sure. You look at some of the things that they've done, and where analysts are at. Out of the 19 analysts that I were able to find, there were 19 buy ratings and 19 hold ratings and only one sell rating. Now, anytime I get one sell rating, my ears perk up because to me, sell ratings are, I can't defend this thing anymore. I don't like it. And you tend to get really like that positive spin. Kind of reminds you of like Fed speak or earnings speak, where everything sounds like it's rainbows, even though it's terrible. And you're looking for gleams like increased pressure, or, you get that language that's really just kind of like mixed in there. You're like, oh, there it is. Your product sucks. Got it. But, they're not going to go out and tell you. So it is very mixed sentiment. And that's kind of one of those things here. And again, no reason to add it to your portfolio. But I really thought for sure, like, oh, this company is like in the dumps based off of what I saw. And it really hasn't been. Spirit Aerosystems, in and of itself is expected to see revenue growth, which projections estimating an increase to $7.11 billion this year and $8.35 billion next year. Our earnings per share is forecasted to improve from negative $4 almost to almost $2 in 2025. So on its own, it's actually expected to improve quite exponentially. So you look at a company like this, and you're like, on its own, not so bad, right? But the industry that it's in and the negative press that it's had, and with these mergers and acquisitions, one of those things is that the deal is it's at risk of not going through like any deal, right? This is kind of like that vertical integration. And sometimes, the government might step in, and they are not on the government's good side right now. They might step in and say, yeah, no, we're not doing this. Like, you're going to fix your own house before you start acquiring others. This isn't going to necessarily help you. Their last few times in front of Congress has not been very pretty. To the point where we saw conservative lawmakers going after executive salaries. Never in my life would I thought I'd see that. And I was like, wait a minute, what? I thought he had a D behind his name, he had an R. I'm like, wait a minute. And so, so I look at this and I say, all right, well, not necessarily a portfolio holding thing for me. The risk of the deal not going through is absolutely palpable on this thing. And, 1/5 of its business is actually from Airbus. So they make parts for not only Boeing, they make parts for Airbus as well, because they're an independent company. They were at one point a wholly like a part of Boeing, and then they spun them off. And so now you look at this and you say, well, okay, a fifth of their business goes away because they have to spin it off for competitive reasons. So that's one of the ways that they were trying to address the, kind of the competitive balance, if you will. And I don't know that, Europe, in terms of the government agencies over there, are going to like the idea of losing a part supplier as well. So there might be some pressure in terms of the backdrop as well. Now the operating margin did decrease due to a lot of the forward losses, particularly in the A350 and A220 program. So maybe spinning off the Airbus stuff isn't necessarily the worst thing in the world. But we look at something like this and we say, well, if we're gonna, from terms of a portfolio hold on this, it's not necessarily very positive idea in terms of where it's at, price versus what the offer is. It's not necessarily where I want it to be, and it's in a space again where, like, there's been a lot of terrible news on this, and so for me, this is not something that I am necessarily looking to buy at all.
Amen, man. I think when we're looking at airplane related companies at the moment, that's a hot button topic, isn't it? There have been so many situations that have been really questionable coming out of Boeing. Boeing's near and dear to my heart. There's a lot of facilities very close to where I've lived over the past couple of years that have been very similar, not very similar, but have been owned in some way, shape, or form by Boeing. My wife is a really big fan of Boeing for their work that they've done in space. They're struggling even in space right now. We have a couple astronauts that are stranded because are
they
Boeing
still stuck?
system,
I was getting ready to ask.
They're still stuck, and it's a Boeing system that's not doing the job that it needs to do. Boeing has received what it seems like is a bit of a media curse over the past couple of months, where every time they put something out, it seems to immediately blow up in their faces, knock on wood. When we're looking to trade this kind of thing, it leaves us in a difficult position because we have to think about things from a perspective of, if Boeing comes in and buys this thing all stock, no cash involved, their stock hasn't been performing well, it doesn't send great signals to investors. Whenever acquisitions are happening, we want to see acquisitions that are clean, at least a mixed deal. Give us a couple billion in cash because you have it and you can afford it. Use the other portion of the deal in order to show, we don't want to spend all of our cash now. We want to be responsible and give some equity, some stock to the company and the shareholders. But when you're doing something that's all stock, it's just a signal to say, we want to buy this company because we feel like this could help save us out of a tough spot, and not that we can really afford it. It doesn't really seem like a great financial decision from that perspective. It seems like they're grasping for straws, and that's particularly
desperate. It just feels desperate. The whole thing feels desperate, and I think it has more to do with Boeing trying to say, okay, well, how do we make sure that we can show up our product? And they're saying, well, if we bring the supplier in house, then maybe we can kind of fix that whole situation over there and kind of improve our own as we try to get right with the world. And it's very important that they do, right? They're America's plane manufacturer. And so we really need them to to kind of pull through here, because there are options out there, obviously, that airlines could look to, but you're talking about for the bigger things, Airbus, and then Airbus does have smaller planes, and then you have Embraer, a Brazilian company out there as well, and then you got the CJs up in Canada. So there's choices out there, but they're not American, and so for the American airplane industry, it's really important that that Boeing gets its act together, and that they're looking to do this with Spirit, but it's not the Spirit that I want for sure. In terms of buying it, definitely not buying Spirit.
Yeah, it's not the Spirit-filled activity that we want to see. Speaking of international relations, speaking of something that's American, that has some international exposure, we always talk about AI stocks. We always have a tendency to talk about something that's a kind of industry and then something that's a little bit more on the AI side. Today, I wanted to switch things up a little bit and actually bring in a real estate based stock, something in REIT. This is Simon Property Group. If any of you guys have been to the U.S., been in the U.S., lived in the U.S., you should be familiar with Simon Property Group because they probably own whatever mall is near your house. They're magnificent at owning malls. And I have to admit, when I was looking for different opportunities as we started pulling back, because maybe we're finally going to see some recessionary pressures in this market, my mind often goes to real estate-based companies because they have so much in the way of assets. Owning land is the number one way for an individual person to become a millionaire here in the States. And that's true of a lot of other companies in the world, countries of the world. And that's true for many companies as well. So owning real estate is a really positive thing. And it's shown for something like the Simon Property Group. Simon Property Group has performed incredibly well since their IPO back in 1993. We have rules when it comes to IPOs. Whenever we're talking, David will oftentimes say that we need to be trading above our IPO in order for us to be confident to buy it. They've been trading above their IPO since they IPO'd. That's not something that we see every day for an equity. When you look up this thing year over year, we do have a little bit of a pullback in 2008, surprise, surprise. But since then, this thing has been skyrocketing, did see some pressure in 2020 to be expected. Kind of got a little volatile here, but we've seen upwards pressure. The chart is what the chart is, and it looks absolutely fantastic. When we're looking at some of the catalysts for why we've been performing super well, we had a really big move in Simon Property a little bit yesterday, something like a 10% move in the stock, which is definitely a little atypical for an REIT. A lot of the reason is because we've seen an incredible amount of large hedge funds, large institutional buying. And the reasons are for a couple different things. I mean, the core of it is there's a lot of positive news coming out of the company. In the first quarter, they signed 259 new leases. They renewed 611 leases. This is over 3.6 million square feet of real estate. This is billions of dollars in rent that they are receiving on an annual basis. So their earnings feel incredibly healthy. Their assets have continually moved up in value. We have continually seen a really strong collection of things that Simon's also added to their portfolio. So not only has Simon Property Group been adding to their real estate portfolio, but as pressures have become more difficult for consumer goods, they've currently begun to buy into a lot of their retail spaces that they currently rent to. For example, a Forever 21, because they've been struggling over the past couple of years, now has a Simon Property Group that has come in and bought up quite a bit of the stock. They own something like 11.2% of Forever 21. So they're starting to diversify where they're getting their money from. Definitely unique. I see David's face over there. It's a unique move, okay? It's a unique move, but they've made money off of it. It's definitely not something you see every day, a landlord taking so much interest in one of their companies that they are actually taking money out of them. Funny story. Currently, Forever 21 is looking for some rent relief, and investors are kind of raising an eyebrow to that because you're asking for rent relief from a company that partially owns you. So
yeah, you got.
We'll see.
So there's a company out there with 10% ownership of you. Like, how about they help you out a little bit?
So,
yeah,
it's a little different, but it just shows the fact that Simon Property Group recognizes that the current situation for real estate owning companies is difficult because we see so many issues in regards to interest rates. That's a really big piece of the puzzle that they have to be really cautious of, because if they can't just go and develop new real estate because it's so expensive, they can't just go and renovate because it's so expensive. And don't you dare mention refinancing, because their current average rate on their mortgages, on $31.4 billion in mortgages, their current average rate is 3.63. So, I mean, when you think about it, that's a magnificent rate. The average rate, David just sold his house. He can tell you, average rate here in the States, if you're getting 6.5, you're doing quite well. And so there's an issue there that we have to talk about and be cautious of. in terms of their current evaluation, everything appears to be pretty positive. Even when we look at a discounted cash flow model, fair value would place them at a $209 fair value stock price compared to 150 where they're trading right now. In comparison to a lot of their peers, their price to earnings ratio is incredibly healthy. It's at 19.2 times earnings, whereas a Realty, very large company here, is at 60.1. And then there's so many other different opportunities that we see here. But the fact of the matter is Simon Property Group feels very, very healthy, even in a long-term portfolio perspective, which you wouldn't expect considering the fact that we're finally starting to pull back. The core thing that I really, really enjoy is that little perspective there in terms of their overall value, looking at price to earnings. The things that I'm not super excited about is their future growth. Their earnings growth rate, their earnings per share growth rate, we're expected to lose a little bit of ground over the next couple of years. It's not crazy, but 3.5% per year is expected to fall in terms of their forecast earnings versus savings rate. That same number applies to their earnings versus the overall market anticipated growth. They're not really expected to grow very aggressively over the next couple of years, and we're seeing things really begin to slow for them, and it's not a great sign in terms of where they are and where they could be for our individual portfolios. So this is one negative thing here that it makes it hard for me to add to my portfolio. But and yet, when you look at the valuations, when you look at where investors or analysts are looking at this thing, you don't see many sellers. In fact, all of the major analysts that have performed analysis on this thing think that we should either be strong buying it, or holding. We really don't have many people that believe we should be selling this thing. All the news that's come out in terms of its upgrades and downgrades have been a ton of people just saying, we need to hold this thing. Morgan Stanley was the last place that downgraded it back in December of last year, and they downgraded it from $180 to $170. So we're still seeing that there's room to grow. We're currently trading at 150.45. The average analyst price target is sitting right around 160. So there's definitely some expected growth there. Over the past 3 quarters, we've seen nothing but beats. The next earnings is going to come up July 31st. Again, things are very dependent upon what we see at that time. But if we can continually see this thing beating earnings, there's no reason why we can't find value and buying it. We just have to be cautious considering the fact that their guidance has shown again and again that earnings will probably slow. Now, in terms of their actual financial reports, where they are financially, I wanted to just show you guys a little bit of this stuff because it's always enlightening to be able to actually take a look at some of this data, because their interest expenses have continually gone up and up and up year over year, quarter over quarter, and this is where things become a little nerve-wracking. You have to remember, whenever you're looking at these earnings reports, especially for publicly traded companies, these dollars are shown in thousands, right? So we're seeing $1 billion in total revenue. Of that $1 billion in total revenue, we're seeing expenses, particularly just in look at their real estate taxes, $109 million in real estate taxes. That's continually going up year over year. Their interest expenses, how much they're spending on interest on their mortgages, is going up year over year as well. Over the past year for Q1, in Q1 of 2023, they spent $200 million in interest expenses. In the same quarter, 2024, they spent $230 million. So we're starting to see their interest expenses begin to push more and more aggressively. Because why? Well, these types of companies, they don't always just keep their mortgages for 30 years. They have to move their money quicker. So their mortgages they have to be turned over a little quicker. So they had to refinance once or twice or 3 times. It's taking a portion of their portfolio, their mortgage portfolio, to be much higher relative to the rest of their portfolio. So although they're still looking at a great average rate at 3.63%, they are hoping, they are crossing their fingers and wiggling their toes for a market that has a lower interest rate decision sometime here soon, because they're starting to really feel the pressure. And here's the thing that really gets me a little nervous about their long-term growth. Asset versus liabilities, their balance sheet. So we're accustomed to seeing companies with debt. That's just a reality of the markets. In order to grow and grow aggressively, you're probably going to have some debt. And when you're in the S&P 500, when you're in the NASDAQ, that debt could be to hundreds of millions or even billions of dollars. What I don't like is the fact that their total liabilities, just in regards to their mortgages, is $25 billion at the moment. Their total assets are 33.7 billion. That's magnificent. Their total mortgages have gone down $500 million year over year. That's fantastic. But their assets have gone down $1 billion year over year. So seeing that their assets have fallen so aggressively, seeing that their mortgages haven't fallen as aggressively, seeing the fact that we're still in a high interest rate environment relative to when they were really buying aggressively in 2020, it leaves Simon Property Group very few options in terms of direction for where they can grow. It's why they're expected not to grow as much, because it's so much harder for them to get cheap money to make the decisions that they need to make. And let's face it, guys, most of what they own are malls. 73% of what they own, 73% of what we see their name on is malls. And we have seen some recovery in how many people are willing to go to malls and purchase things. But I can't tell you the last time I've been the one. Maybe my wedding suit. I bought that a year ago. It doesn't help the fact that they are looking at continually investing in these spaces where we're seeing less and less foot traffic year over year. Now, the thing is, although we look at these numbers, we look at their assets, we see that they have an incredible amount of mortgages that need to be paid. Their lease liabilities are $525 million on top of their mortgages. There's a lot of fun stuff that I talk about there. Although I say that, when we look at it on the chart's been performing incredibly well. It feels weird to me because, again, this is a stock that is based in and around selling malls. They're buying up malls, they're renovating them, they're making them look great, but they're coming in on the back end now and they're doing things like, for example, the Philadelphia mall that they just started renovating 2 years ago. They're trying to sell, they're trying to get rid of that. That's right up in David's neck of the woods. It would make you think that the stock should be performing worse. So I thought, what if we looked at some of their competitors? What if we looked at a company like a KRC, a Kilroy? You'll see this company around a lot of places and spaces, and people will say, this is the next REIT for you to put your money in. I've seen companies like Zacks Research. Zacks is incredibly well known for their research on equities, say that this is where money needs to be. Moody's has written a ton of great stuff on Kilroy. Let's look at how it's performed this year, guys. It hasn't. You know, when you look at where we were at the beginning of the year, this thing has fallen off of a cliff. Just for giggles, we can actually take a look at roughly how much it's lost over that period of time this year. We're down 22%, this particular equity. And yet we're still seeing all this positive press. We're seeing all this positivity because they do really cool work. They own a lot of leases in hot areas like Austin and California, LA, San Francisco. They specifically own a lot of life sciences related facilities. That's super exciting. But the reality of it is, it's not super exciting if they're not making money, and they're not making money. But that's just one example, Aaron. Why wouldn't you just tell us about more in the markets? That's no problem. That's no problem. There are other companies I was excited about too. Let's talk about a PEB, a Petalbrook Hotel Trust. This company's near and dear to my heart. My wife loves their hotels. All they do is they deal in boutique hotels and really interesting individual names that are incredibly expensive to stay at. They're all about experiences. Fundamentally, I want to believe in this company because I think it's cool. I want to be in companies that I think are cool. But again, the reality of it is the equity hasn't performed well since the beginning of the year. Now, it's not nearly as bad as a Kilroy, but when you look at its overall performance, we're still down 11%. since the beginning of the year. And this is another company that's received nothing but positive press. It's beat earnings again and again and again. But the fact of the matter is they've been slowing really aggressively, and it makes investors nervous. So everyone can write all the nice things they want, put flower and perfume on the stock. If it's not making money, it's not making money, and we're not staying in it. Whereas a Simon Property Group, we've been writing about it and how it's negatively been performing for months on end. And yet, when you look at the overall performance of the equity, year over year, when you look at where we actually are, let's see here. Overall performance has us actually up, not much. 7% isn't great, but it's a lot better than down -11. So there's a lot of things to keep in mind here. All in all, I think this is a great opportunity for a swing trade, nice little bounce off of some news here. I do think that this is a great opportunity to start thinking about adding to my portfolio in order to see it as a strong add to my portfolio. I am building a core position now, but I really want to see it break above this high and begin to hold. I totally believe it can. That wouldn't be an all-time high. All-time highs are much higher, as you can see, from 2021 and then back to 2020. But I do believe that as we begin to hold above these 150 areas, we could find some real strength. As long as the next earnings are positive and don't slow too aggressively, I do believe that Simon Property Group will perform well, especially as we see the Federal Reserve begin to talk more and more about cutting rates. So maybe not a big buy for my portfolio today, but I think tomorrow it's a really great opportunity.
Yeah, I hate real estate right now. And here's what I mean by it. So everybody knows about it. Everybody knows about it. And it's kind of like trading a pattern in the market. Once everybody trades a pattern, right, then the market knows about it, then that pattern quits working. That's just how this works, right? Because buyers and sellers are all sitting at the same place. And so then we have to change our execution style or what we're looking for. And funny thing, right? You told us about all that positive analyst news on stocks that were underperforming and all that negative analyst news on stocks that were overperforming, right? You're like Simon Energy Groups, everybody's leaving the mall. Everybody's not coming back. And you have all these anchor stores closing down. We talked about the Macy's of the world, the Kohl's of the world. They're not renewing their leases. They're having to close down stores. And what is the mall going to do? Well, you look at the stock and it's not necessarily reflective of what you see going down the street. So it does bode well for the company to be able to do things within its pocketbook in order to make sure that it could weather this. But how does Simon come out of this, and how does it reinvent the mall space after this, right? Because it's not going to be just shopping for items. It's going to be experiences. It's going to be a little bit different. I remember seeing a mall back home where they added like an indoor theme park type deal in one of the anchor spaces. And so I think you're going to see reinvention of those things and invention. And it's going to be more like when I was in South Korea, it was like this. It was an entertainment center, not just shopping, but it was shopping and entertainment. And it was all co-located.
Exactly.
So you can kind of get there and have a full day's experience in there versus specifically shopping. So very interesting
and real
conversation.
Quick, I have to add to what you were saying there, because that's exactly what they've been doing. They've been pivoting, and that's such a difficult thing for companies to do. One thing I neglected to mention: one, they have a great dividend yield. Their dividend yield is like 5.32%. They've raised their dividend almost every year over the past 11 years. But one thing that they've been doing really, really well is they've been pivoting like that and trying to make things more of an experience. There are more theaters in their malls now. There are more kids-related things in their malls now. When I go to Orlando, they have a mall where there's a bunch of jiu-jitsu places. There's so much that they're adding that's super weird and is incredibly different and is fresh and is interesting. And I think that that's a really endearing piece of the puzzle. The last thing I'll say about it, year over year, we see these companies do things the same way time and time again. One thing that Simon's done really well, 11% of their portfolio makes most of their money online. And they've begun buying into those retail spaces so that they're actually getting revenue from online purchases. When's the last time you heard of a real estate stock producing revenue from online sales? It's just, you don't see it every day. You don't see it every day.
No, and that's kind of like I had to chuckle because it's like either adapt or die, right? You have to diversify what you do, and you got your core holding, and then you got things to do that you do in order to make sure that you can keep things running. Let's get into the last segment of the show. I'm talking about a stock that is in an industry that's really kind of fallen out of favor as I look to rotate out of the AI, if you will. If by and large, if we're talking about, hey, are we topping here at least for now, waiting for a pullback? Are there any other opportunities in these markets that we could look at and see? And what are people talking about? One of the stocks that people have been talking about here recently is SolarEdge. And SolarEdge, for a variety of reasons, has been in the news. One of these, SolarEdge produces like power solutions for your home, like solar panels, electrification systems, that sort of thing. And in terms of I love the idea of renewable energy sources. I really, really do. And making that widespread and reducing our dependence on fossil fuel. I mean, the sun's there. It's there every day. So why don't we use it? I think SolarEdge's claim to fame is they have a direct current optimized inverter system, which maximizes, to them, what they say is maximizes power generation while reducing the energy costs to produce that power. When we talk about like the direct current versus the alternating current, direct current, alternating current is easier over large distances, and direct current is great for closed loop systems or smaller systems. And so obviously in this application, it really makes a lot of sense to go with a direct current system because you're powering your own home. You're not necessarily powering a whole grid and looking to take that power and push it hundreds of miles. All right. But this is a stock show, not a science show. So we'll get to it. So looking at the chart here, really hasn't been that good since we talk about middle of last year. Really kind of fell off. The whole industry's kind of been like this in terms of the solar industry. It just kind of fell out of favor with investors and traders, and it's just been kind of going down. We had all this consolidation in and around, call it the $280 to $300 mark. You had dips down in the 200 that were bought up, and it was bought up even as late as October of 22. This dip down in a 188, kind of bought back up, pushed back up into that 300, that 320 area. But now, since then it's sold off, and look at where we're at down here at 30. In the pre-market, $28.34 in the pre-market.
Jesus.
These are the daily charts, and we'll zoom in. I had to zoom back out, but this is the price action that we've seen most recently on SolarEdge. And the reason why I'm not necessarily trying to pick on SolarEdge, but it's kind of been out there as people have been talking about it because they've had some recent news. And let me get this pulled up. All right. So one of the things they did here recently is they are offering $300 million in convertible senior notes for 2029. And they're looking to basically take their 2025 debt and push it in the 2029. So basically they're going to use the money that they raised from this to pay to basically cover the debt that's coming due in 2025.
Wow.
And one of the frustrating things to me, and this is why I want investors or traders, you do what you want, but really have your own conviction on what you think that means to you. Don't necessarily go by what somebody says that means to them. Do your own work. And I'm sitting here saying that as somebody who's spouting off an opinion on an equity. Do your own research, find your own comfort with it, and make sure that it makes sense to you. And if you don't like it, you don't trade it, don't buy it. And one of the things that I read that was super frustrating to me was somebody trying to put a positive spin on a Solar Edge stock that's down so much, that's offered these, $300 million in convertible senior notes, looking to refinance their 2025 debt and kick the can down the road another 4 years. And I'm like, oh boy, if you go in right now, you are, in my opinion, asking for it. And why am I saying that? When I look at Solar Edge's website right now, granted, they're advertising, they're showing it. I'm looking at it and I'm like, if I'm looking to make my energy more efficient, and like, I would love to have a Solar Edge system, and I don't think that they're any worse off than any of the other competition. But what I will say is that high ticket items in tightening economic times is not a good idea. And when you talk about Solar Edge, the average price for a system here in the US is about $14,000 prior to incentives. How many years are you going to pay energy bills to even get that thing back? And if you're financing, even half of that at these higher interest rates, again, you go back to your savings, right? They get kicked down the road. And one of the things that's been frustrating, right, the investor, the person that's been trying to move their money, is that, right now isn't the time to buy things. Right now is the time to kind of look around, find value in things, and create your shopping list, so that when things get cheap and people decide to get the heck out of these stocks or get out of these things, then you can go back into it. When I look at Solar Edge's chart, I don't like the way it's fallen. I like where it's currently sitting on the chart, if it provides a long enough period of consolidation, because I'm not buying it at $300. I'm buying it at like 20 some odd dollars. So in terms of like where it is, I like the idea. The problem is, can the company make it between now and then? And you're telling me that they're offering these convertible senior notes. I don't necessarily like the idea. I like the space that it's in terms of just like my heart goes with these solar companies. I like the idea of, but like now you're a publicly traded company, and what publicly, I mean, ask McDonald's how much they got to charge for a cheeseburger to please the shareholder, so now you can't operate, solely on your business. You're having to answer the shareholders. I mean, a company's market cap that decreased by almost 90%, 87.54%. You've lost 90% of your value, and now you're offering convertible senior notes. This is, if somebody goes in here and buys this thing, it's the most extreme buy the dip type deal, that you could ask for, because you're getting it at a 90% discount. But again, I don't necessarily like the idea. I like the idea that they're very global. I like the idea that they're just not reliant on U.S. markets. It's an Israel-based company that does business in Europe as well. So I like that. But if you get most of the stuff made in China, everybody's mad at China all of a sudden. Europe's mad at China. We're always mad at China for some reason or another.
Always mad at China.
And now you're talking about tariffs on Chinese produced goods. How does that impact Solar Edge? They do face pressures on that as well. So I look at this and I say, well, I can't find myself buying it for sure. One last thing I wanted to share before we left, because we do have to be out of here on time, otherwise Jordan will yell at me, is pay attention to delinquency rates on loans. They're starting to creep up. Start looking at that. Start looking at where we're at in terms of a market cycle, because I'm starting to feel kind of a shift, which could lead to some interest rate reduction, at least 0.25%. But pay attention to that credit card debt. That's the one I'm looking at the most. Right now, we are creeping ever so slightly higher, not necessarily as bad as 2010, but we're above the norm, and it seems to be climbing. But we got to get out of here. We got places to be and things to do. So on behalf of Aaron, I appreciate you guys joining us. Come back tomorrow, J&J in the morning. Got Rich on the live trading floor. We'll get back after it. See you guys.